Welcome to Nexgen Software Services. We're very excited to teach you how to make money day trading Fibonacci. One of the key components is our Nexgen Dynamic Renko bar. The bar type that Nexgen Software uses, we've created ourselves. It's called a Nexgen Dynamic Renko bar. And the only thing that you're going to really concern yourself with is, and again, we've already set up the size of the bar, but you'll see here on the input, body size equals 14 ticks, and then 2 ticks to make a new bar. Now what that means is, and you'll see pretty easily from looking at the chart, the body size of every one of the bars is exactly 14 ticks. So we have a very, very symmetrical bar. What that also means is that, again, assuming that you have an opening price to every bar, if we go 14 ticks below the opening price, we'll start making down bars. And we have an indicator that plots the price at which we will start making down bars. So again, we'll use this a lot more later, but as long as we're making up bars and we're not making down bars, we're going to look for long trades or buy signals in the market. This reversal bar marker will be 14 ticks below the low of this bar. So we'll only need 2 more ticks to make a new up bar, and we'll need 14 more ticks below this price, and you can see it's represented on our chart here, before we'll make a down bar. Now, not to confuse you too much or get too much into it, but one of the things that we will do is we will take the 14-2 reversal bar marker price, and we will superimpose that price on top of a smaller 5-1 bar. And again, on the Nexgen Dynamic Renko bar, keep in mind it's only 5 ticks now for down bars, and then all of the bodies of the bars going up are only 5 ticks. So it's a much faster chart. So, again, just to start building some terminology, what we're looking for is the large chart, the 14-2 chart, to go up, which is represented by, staying above this reversal bar marker price. And then on our smaller charts, we want to have these little pullbacks where our rules are met. And again, we're not going to get into rules yet, so I don't want to get too far ahead. But pretty easy to see. If the market's going up and we don't reach this reversal bar marker, we're going to continue to do long trades. Nexgen software, our T3 Fibs Pro Trader indicator is one of the mainstays. And what this software program will do is it will allow us to have Fibonacci analysis automated. Now, I'll give you a short little course on Fibonacci analysis, but the short version is our software will build 10 time frames of different charts in the background, and it will do all of the Fibonacci analysis for us. Now, most people are familiar with Fibonacci retracements, so they'll start at the top and they'll pull the indicator down, and you'll see that the market made a little more than a 40% retracement before the market went down, which is really nice. There's nothing wrong with that. So those are retracement type Fibonacci projections. The other type of Fibonacci projection that people use, just to kind of show you here on the chart, they will use what's called projections. And when you use an extension or a projection, you'll start at one pivot and go to the next, and then when you pull it down to wherever the market retraced, you'll have these Fibonacci projection numbers, 100%, 138%, and so on. And essentially what you're doing when you're doing Fibonacci is you're using the prior swings in the market, which are very absolute, right? What does a swing in the market represent? The swing in the market represents the price at which nobody else was willing to sell, nobody else was willing to buy, nobody else was willing to sell. So the pivots themselves are a good representation of the overall interpretation of the market, everybody's interpretation of the market. So what our software does is it will literally do every retracement, every swing, and every projection for every swing in the market for 30 days worth of data, which really builds, hundreds, if not thousands, of Fibonacci projections. And the beauty of our software, what it will do for you, just stop moving this around for a minute, is it will take these thousands of projections and thousands of retracements, and it will just generate a red or a blue line for you. And when you have a red line, that's what we call Fibonacci resistance. And one of two things is going to happen at a red line. The market's going to reverse, or the market's going to break through. Again, the market can't stay in a range forever. So our job as we work our way through the education and the trading plan is to teach you how to recognize when one of these red lines will hold, so you can take a short position and make a bunch of money when the market goes down. Or to be able to teach you, and again, we have to get to some other pieces of our software first, when these blue lines are actually going to hold, so you can buy the market and you can make money when the market is going to go up. So everything that we will be working on going forward is to predict when one of these lines is supposed to hold, and we're going to use a couple additional indicators. And again, as we progress through, you'll see, Fibonacci areas will break. So, and that's okay. I mean, that's going to happen, and I'll get you back to just, this is Friday here. It's okay if they hold or break. It's our job to figure out, if they hold, how are we going to take advantage of that? If the market bars are going up and not making down bars, how are we going to take advantage of that and trade to the upside? So we're going to use these areas as entry points. We're also going to use these Fibonacci support and not only entry areas, but as exit areas as well. And then when the market breaks Fibonacci resistance and it turns into support, when are we going to use that support to tell us to continue buying when the bars are going up? So the other component or thing that is inside of our T3 Fibs Pro Trader that we use is this little moving average. And again, it's what we call our mid-band. Without getting too tricky, it's very easy. It's a 55 period exponential moving average. And in this indicator, when it's green, we'll have the potential to buy off of that green mid-band to go up. If the mid-band is magenta, again, we haven't gone down for a couple days here, but if the mid-band is magenta, it will become resistance for us. And, again, depending on our rules and the situation, could potentially be a resistance area that we would use to sell in order to make it down to our Fibonacci support. And again, we're going to go through a lot of rules on when you can use that as an entry area and when you can't use it as an entry area, such as, the market reversed from Fibonacci support. So that's no longer going to be worthwhile in using. So we're going to go through and talk about Fibonacci areas and, the next indicator are trigger lines and how those two things will work together. There's one more small piece that we'll be doing. We have an extra indicator called our T3 Fibs Pro Trader Synthetic. And what this indicator will do, it will allow us to, on a smaller chart, such as a 5-1 dynamic Renko bar, it will allow us to plot Fibonacci support and resistance lines from other charts. So on this smaller chart, we can superimpose the 14-2 chart Fibonacci support and resistance areas. We can actually take our range bar chart, and if we wish to plot support and resistance, we can literally plot support and resistance from a bunch of different charts on top of a smaller chart. So what we end up with, and there's two trades that we will end up doing. We will do trades with the trend, and we call them trend trades. And then we will do trades at multiple time frame Fibonacci support or resistance. And that just means whenever you've got more than one line on a chart at the same spot, it starts to add power to what we do. And again, it just, I don't want to confuse you too much, but as we progress through the rules and the reading of the indicators, this is going to make a lot of sense to you. So for now, red lines are resistance, and our goal is when can we use them? Blue lines are support. When can we use them? When can we not use them? And once we put this whole trading plan together, you'll be very, very confident knowing exactly where to go short. You'll be perfectly confident knowing exactly when to go long and the reasons why. It's reading your Fibonacci areas and reading your trigger lines. Once you understand the simplicity of reading your fib areas and your trigger lines, all of our trading setups are going to become intuitive for you. So we use two main charts. We use a larger chart, which we call our 14-2 chart, and we use a 5-1 chart to help us time our entries. And on this chart, I have our T3 trigger lines plotted. So you can see there's red trigger lines that go down and then they cross back up, and green trigger lines when they're going up. What we do is we actually have that same indicator value plotted on our smaller chart. So you'll see, again, these what we call synthetic triggers, but they're nothing more than the 14-2 triggers. They'll also cross up and be going up. Now, what we're trying to do, and what you will learn as you're progressing through reading our software, when we have really strong down triggers, we're going to look for these retracements in price. And those are the spots where, if our trend trade rules are met, we're going to be doing trend trades. And again, we've got, some simplistic ideas for you. If the trigger lines are physically breaking through Fibonacci areas, we're going to expect the market to continue in that direction. If these trigger lines roll or stop at a Fibonacci area, we're going to expect the market to reverse from that Fibonacci area. So this really is the secret to reading our Fibonacci areas. Trigger lines get beyond it, usually you do more trades in that direction. If they stop at it, you're going to go the other way. So let's take a look at, just a real simple chart that we've put together. First things first, small trigger lines on our chart. And again, it doesn't matter whether this is a 5-1 chart or the 14-2 chart. If the trigger lines do not break below the blue lines we anticipate to hold. If the trigger lines break above, but just a little bit, we'll wait for the trigger lines to get back below, and then our Fibonacci resistance will hold. Anytime the market makes a very strong push into a Fibonacci area, meaning, 20, 30, 40 bars with the trigger lines crossed down, you have to wait for the triggers to roll up, because a lot of times the triggers will break through. And when we break through a Fibonacci area, we will continue to trade in the direction of the trend. So when the triggers are below, resistance should hold and we'll trade down. Again, notice when we reach the next blue line, we do not have the triggers above the blue line, which means the blue line will probably turn red, and when it does, we can continue to do short trades. This is a generalized version of what you're going to look like on your larger 14-2 chart. And you're going to see small trigger lines. Of course, we're going to have Fibonacci areas on there and the rest of our indicators, but from the large chart, this is the first and foremost indicator that you're going to read and why we superimpose this indicator on our smaller chart. Short version is you're going to see price pulling back to trigger lines that cross over to the downside. And then the bodies of the bars are going to be below the trigger lines on the big chart, and we're going to get these retracements that eventually make a tail. And when we have this wide trigger line look and we have these big tails, that's what we call a stab back. You'll hear us say that in class a lot. This is where we do our trend trade shorts. And eventually price gets above the triggers and they'll roll and they'll cross back up. And if we're at the right spot, again, we'll look for long trades. And then eventually, the process kind of repeats itself going back and forth. We pull back to trigger lines that cross over. If they're really wide and down, we're going to look for continued short trades. One of the things that Nexgen does is we obviously use multiple time frames on single charts. The trigger lines are no exception. So this is what your charts are going to look like. And again, just to recognize, this is a 5-1 Nexgen dynamic Renko bar. And you can see we've got our small trigger lines. That's what we call them in class. So you'll see that a lot. Small triggers, which are just the trigger lines from the 5-1 chart. And then the other triggers that you'll see, if you recall, are the 14-2 or the larger chart. Again, it just, depending on what time frame you're using, but in our case here, 14-2 small triggers, and we also call them synthetic triggers. So those two terms, if you will be interchangeable, whether we say synthetic triggers or 14-2 triggers, either way. Now there's a couple of relationships on your chart that you're going to notice. The first of which is a background color. And the background color, when the 14-2 triggers cross over, will cross to the downside. So when they cross down, the background color paints red. Pretty easy. And then when the 14-2 triggers cross up, as you see over here, the background color will change to green. Now, what we look for is when the market is going down and our trigger lines are going down, we look for some type of short signal, or we look for our rules to be met. Now, we're not quite yet at the point where we're going to start going through rules yet. So, there's only a couple of things that I really want you to learn in this section. Number one, that we have triggers from our 14-2 chart superimposed on top of our smaller chart. We have smaller triggers on our 5-1 chart. So again, just two sets of trigger lines, one from the big chart, one from the little chart. Location, location, location. That's very, very, very important. When we start looking at our trading rules, the location of our trigger lines relative to the other trigger lines are going to be important. In the last little section, we talked about location of the trigger lines relative to our Fibonacci areas as being important. Well, if the small trigger lines are physically below the synthetic trigger lines, we have much easier, higher probability trend trade shorts. Once our small triggers get on the opposite side of our synthetic triggers, we can still do shorts if the conditions are right, but if they're not right, or say, for example, we came from Fibonacci support, then we would no longer do short trades, even though the triggers are on the wrong side. So again, there's two things that we want you to know. Number one, small triggers from the large chart and the small chart are going to be on the same chart. The background color obviously will coordinate with the direction of the larger triggers. And then location of your triggers versus the other triggers. And again, this is going to be instrumental when we get to the point of doing trend trades. Because, when they're on the correct side, trend trades are pretty easy to the short side. Again, when you'll see as we start working our way into the rules, when they're on the correct side, we get some pretty easy long trades. However, there are some instances where the market will be on the small triggers will physically be on the wrong side of our 14-2 triggers, and we'll still do a trade. I'm going to load for you really quickly just the trigger lines and the 14-2 reversal bar marker, so you can start to see how these things come together. Again, if the small triggers are on the correct side or not below the synthetic triggers, we'll have an easier long trade. If the small triggers get below the larger triggers, but they're still crossed up strong, we can still do another long trade, as long as, you remember, we don't take out or exceed the 14-2 reversal bar marker. Because traditionally, once you exceed that marker, and I'll draw a little circle on for you over here on the left, you'll see what happens. Our trigger lines cross up, and it really just means that your trend trade's down, the potential for a down trade once the background color changes is over. Usually that happens where that 14-2 reversal bar marker is. That's why we superimpose them. So again, as you work your way through the rules, you'll see there will be situations where you'll have trend trades where the small triggers are on the correct side of your 14-2 triggers. And then we'll also be able to do trend trades that are on the wrong side as long as we do not exceed the 14-2 reversal bar marker. And again, as we start to add in Fibonacci support and resistance areas, this will also become much more apparent to you. So again, just a reminder, correct side of the triggers looks like this. This one looks like the wrong side, but it still goes up anyway. So this is where we're going to use two rules in our trading plan to determine getting in a little earlier when they're on the correct side, or getting in a little closer to the 14-2 reversal bar marker if we're on the wrong side. One more concept, or one more little section for trigger lines, and then we'll have most of the major concepts covered. One concept that we use over and over and over again is a very strong trigger line look. And essentially, when we say the words strong trigger lines, what we're saying is strong trigger lines that are wide and up. Now, in this case, this is our 14-2 larger chart. So again, you'll get into some more videos and education that you'll see that our 14-2 chart kind of steers us in the right direction. This look right here, and again, I'm going to circle it for you, is a look where our small triggers are physically above the up synthetic triggers on this chart. So again, these synthetic triggers on the 14-2 chart come from a much larger chart. But it's the relationship of these small triggers being wide up and also having wide up synthetic triggers at the same time. These little pullbacks are the spots where we will get into trades and look for the market to continue to the upside. When you reach an area, if you've got this look, so again, I'm going to just kind of back this up just a little bit right here. I'm going to draw in a box for you right here. If you have this super strong look as you reach a Fibonacci area, very, very low chances of that area holding. Typically, we look for that area to break. Or if it is this strong, what we want to see is our small triggers cross and get below the synthetic triggers. That's kind of the first warning sign that the market's going to turn. So again, just because we have Fibonacci resistance is not a guarantee that it's going to hold. So when our trigger lines look like this, it's going to break, and we'll continue to do trades with the background color and the direction going up. As the market starts to weaken, right? So we put in our first move to the downside. It's really vitally important that you recognize that the small triggers are making a strong push below the synthetic triggers, which will bring us to our next concept. Two things are going to happen. Number one, the market will just keep going down indefinitely, which is usually not the case. The second option is if we get back to either support or a green mid-band, what we start to contend with is what we call a large gap. And you'll see this a lot on our charts, large charts and small charts. So the large gap means that you've hit a support line. And again, a green mid-band for us right here is our support line. And traditionally, what we want to do is we want to take a look at where our synthetic triggers are located. So what happens is, imagine your small triggers are a rubber band, and somebody is pulling the rubber band really far away from the synthetic triggers. Usually we'll get this snap back, if you will, at least towards the synthetic triggers, if not all the way to them and then through them. And you'll see this same exact concept. They don't have to necessarily be crossed up, even if the synthetic triggers are crossed down, as they are right here on the right edge of the chart. You know, where this synthetic trigger is important, and, you know, again, we're going to use this term a lot, big gap. And all it means is that the support area, which you can see hopefully now pretty easily down here, blue Fibonacci support, and then the distance from the small triggers and that support back to the synthetic triggers creates a big gap. And what this big gap will do is it will start to give us the ability to predict that this Fibonacci area will hold. So again, we're using, you know, a couple of things. Number one, you know, and I want you to look almost at this same area to the left, the beginning of the chart. If the triggers are super, super, super strong and going up, we almost always break whatever area we come across. If the triggers remain strong and wide to the upside, we'll continue to do long trades or buy signals as long as the market and the triggers remain strong and we haven't reached a target. As the market starts to weaken, you'll be able to physically see the weakening, or the first time where our small triggers get below the synthetic triggers. And usually we get one more bounce up to retest, you know, from a support or a mid-band. And, you know, if we fail to get back above the synthetic triggers again, which we failed here, the market will traditionally start trading back down to the downside. So again, if we were long, we would watch our positions. And if we had reasons to go short, let's say here on our smaller chart, we may start taking short trades, because the location of our small triggers is on the wrong side of our, or below our synthetic triggers. Then as we reach support, we have to evaluate again. Where are the small triggers? Yes, they're pretty strong down into the area. However, that is trumped by the fact that we have this big gap. And this is really the outcome of what we're looking for when we have a big gap. And then, again, we go right back to the same thought process. Trigger line location is above right? So if our synthetic triggers are violated by the small triggers in price, as we pull back again to support areas, green mid-bands, Fibonacci areas, we start to build a case for the market to go back up and to reach our next Fibonacci resistance, which, again, this would have been our target area. And again, you can see this is another case of strong trigger lines going up into a Fibonacci resistance. And again, this happens a lot when they're strong. Resistance will break. We'll look forward to opportunities right here where we can actually take long positions on pullbacks to the support. And, if all goes well, the market will continue to the upside. So again, just a short recap. If the triggers are super strong heading into a resistance, don't try to go the other way. Wait for it to break or roll. If they remain strong, just keep remembering trend trade long or short, depending on direction. Once the small triggers make a sharp move, right, below these synthetic triggers, again, you're going to bounce. Obviously, the bigger the gap, the bigger the bounce. And then when we use this same logic, as we're looking at either mid bands holding or Fibonacci areas holding, location of triggers versus the triggers is important, and location of triggers versus our Fibonacci areas, as you've already seen, are very important. Again, to review, if you look over here at the left side of my chart, I'm going to draw a circle. This is the concept of very strong trigger lines going to the upside. Now, initially in this very first circle, what do you see? You see Fibonacci resistance, and it starts off with none of the trigger lines breaking through the Fibonacci area. So there's two reads that we have at our Fibonacci area here. The first read is that our trigger lines did not break above Fibonacci. Right, so obviously we had, and again, I don't want to go too far back, but I think it's pretty easy to see that when your triggers break above a Fibonacci area, we're going to continue to look for long trades. And if the trigger lines move up again, and we will continue to again look for pullbacks for long trades. And eventually we're going to hit a Fibonacci resistance. Here, I'll put a box on it for you. And we have to, obviously that's probably your profit target, but we have to determine if we want to go short at that area or not. And remember what I said in the last section, if your small triggers are going up strong and your synthetic triggers are going up strong, you will traditionally break above the resistance. And you can see, this was from Thursday, I guess. You can see the market goes up to the next resistance. And again, the market will break resistances. Sometimes you get a really strong trending market, and you have to recognize this look of being very strong triggers. Don't go against it. Now, per our last section, the first time that the small triggers weaken or get below the synthetic triggers, you can see what happens. We get one more final run to the upside. And again, this weakening of the small triggers finally says that because the fibs were not violated by the trigger lines, and we had the small triggers get below the synthetic triggers, then this usually will, this will end up being your last long attempt. And sometimes you don't even take that last long attempt. But again, you have to recognize the location of your triggers relative to your fibs. And, again, this is one of those big gaps back to the synthetic triggers, right? So, again, you'll start recognizing these as time progresses. Now, I want to introduce another concept that happens a lot at Fibonacci areas. It's what we call a pivot stop out. So if you take this yellow box that we're looking at right here, a lot of times when the triggers don't break through, the market will come back up and go just a little bit beyond that high, and then it will reverse very, very quickly. And you're going to use this literally every day, sometimes 4 or 5 times a day. So pivot stop out is what we like to call it. And it just means that price went higher than the last pivot, right? So for people who went short here, this is usually a stop run and then a reversal. So again, if you barely violate the last pivot and the last pivot said that the resistance should hold, you'll start to end up with a better thought process that you might be at a potential top. Now I want to reintroduce one of the slides that we looked at a lot earlier when we were looking at our fibs and trigger lines, small trigger lines only. Initially, if you're at a Fibonacci area and you're starting to anticipate that it might hold, but the small triggers violate above it, we have to wait for one of two things to happen. Either the Fibonacci area to turn from red to blue, in which case it's broken and we'll keep trading with the trend, or the small triggers physically get back below the resistance. Remember this one? Then we can actually use the resistance to go the other way. So when we look at this chart, just a quick little review, you'll see the pivot stop out number 1. However, we can't necessarily go short up here. However, when the small triggers get back below the fibs and the synthetic triggers, this spot becomes the exact spot where we look to initiate the first short position against the trend. So again, this is really, really typical of what happens almost every day. Strong triggers break fibs, strong triggers break fibs, strong triggers finally don't break the fibs. Then you get one more last attempt, as long as you don't start making down bars past your 14-2 reversal bar marker, remember. And then after a pivot stop out or a retest of resistance, we wait for the trigger lines to get on the correct side, and then we'll end up taking short trades. And then as we scroll forward, you'll start to see, obviously, the market trades down into support. And you'll see that, even though we're at support, the trigger lines physically got below the support, which is very important. So when we pull back and we retest the triggers that have crossed down for the first time, we're going to be looking for some type of a short or going down trade over in this area. And again, you'll see the background color really helps with this. And, as this progresses, you'll see the market goes down and hopefully, obviously making some money. And, the same thing holds true. Then we get back into the same type of reading that we were doing before, which is what? If the small triggers are below the synthetic triggers, right? So you can start to see how we piece together our trade setups. Small triggers physically below, we're going to continue to look for more short trades. And, this same look as we start to get into trade management will mean that, when the triggers are going down, the synthetic triggers, and the small triggers are below, we almost always make it to our Fibonacci target. So again, it's imperative to read, not only your fibs and triggers, but your trigger line location, and that will help you as we start to work our way into trade management on what's going to happen next. In continuing to look at the indicators that will be in our trading plan, down at the bottom, you'll see our fib to fib oscillator. And again, this is a proprietary oscillator that we've put together that will help us to determine when we've had enough of a pullback to take a trend trade. So again, there's multiple layers that we're adding in here. The short version is, and the rules for a trend trade long is that we want this oscillator to either be at 25 or 0. We want it to be in the lower 25% for a buy signal. So what we end up with and what the trade would be in this situation is, again, reading your fibs and triggers, you can see that the trigger lines have broken through Fibonacci resistance and that the trigger lines are going up strong. And then the market makes a retracement. And again, during this retracement, you'll see that our fib to fib oscillator satisfies the thought process for being in the lower 25%, which will help us to pick the right spot from which to go long. And again, one of the things that, we talk about is Fibonacci areas breaking. Again, when the triggers are very wide, synthetic triggers, very wide and very strong, we're going to go to the next fib. And usually when we go to the next fib, then we, again, read our fibs and triggers, and you can see, obviously, the market's going to continue to go up. So as long as the trigger lines are very favorable, and again, we'll just do a little bit of reading here, trigger lines going up strong and breaking through resistance and price pulling back to support and the fib to fib oscillator pulling back to the 25 buy line, it's going to enable us to do two things: to recognize that our small triggers are not below the synthetic triggers, which means we need to look at the first area of support for going long instead of the last. And number two, more importantly, we know where the next target is. The next target's at our next Fibonacci resistance area. And again, as time progresses and we work through, the market going up and then the market changing direction, and again, you'll start to see, again, I don't have every indicator on here yet, but you'll start to see the opposite happen. So, you'll start to recognize the weakening of your triggers and your trend and the trigger line starting to pinch over. And you'll see, another pattern that happens a lot in our fib to fib oscillator, which is a sharp point. And all that really means is that the fib to fib oscillator was at 100 or 75 for only one bar. And it makes, what very visibly looks like a sharp point on your oscillator. Now, by itself, not very powerful. When you add to the idea that you have a sharp point on your fib to fib oscillator and you're at Fibonacci resistance and the small triggers have gotten below the synthetic triggers, and you put it all together, you start to anticipate that this area may potentially be a top for you. Now, again, you remember the picture that, again, we refer to this picture quite a bit. You'll see strong triggers breaking or strong triggers into resistance. And then after the triggers get back down below the resistance works. Well, when that happens, so again, you can kind of see that process over here. Strong small triggers into resistance the first time. The second time we hit resistance, again, this is just trigger line reading. Look at where your small triggers are. Your small triggers are considerably lower than they were the first time when they were strong into the area. This area becomes a higher probability area for the market to reverse. So again, we've got multiple layers working for us at this Fibonacci resistance. Lower small triggers, which is good. Small triggers below our synthetic triggers, which is good. And then the other thing that you'll notice is that even though price almost makes, an equal high at the top, the fib to fib oscillator has a lower low. So we have the potential for, really a divergence between the price and the fib to fib oscillator. So this will help to add, again, confidence at an area. Number one, you had a sharp point. Number two, the small triggers are below the synthetic triggers. Number three, you have lower highs on your fib to fib oscillator, and we end up with a potential top. Now again, starting off, you're going to probably start with trend trades and with the background color of the chart, which is fine. We're going to use the fib to fib oscillator in that scenario as well. So the same way we use the fib to fib oscillator in the lower 25% for long trades, we're going to use the fib to fib oscillator in the upper 25% for short trades to help us define when and where we can start looking for a potential trade with the background color, with the small triggers below the synthetic triggers, with the fib to fib oscillator at the 75 or 100 upper 25%. And then you'll see what happens. The market goes down and we pull back for yet again another potential short trade. And you'll see that not only do we have our small triggers inside or below the synthetic triggers, we have Fibonacci resistance, and we have our midband, which again, part of our rules is determining where we're going to get short. And then the final piece of our rules are fib to fib oscillator in the upper 25%. So it creates a very, very strong, very high probability trade. And then as you progress forward, you'll start to see, the opposite. Once we get above, or the trigger lines get above our synthetic triggers, if the market fails to get back below the synthetic triggers, if for some reason you were still short, you'll recognize the sharp point on your fib to fib oscillator at the 25 buy line this time. So it's kind of the opposite pattern of what we had over here at the top, where we had lower highs. And now over here, we've got higher triggers. Look at the small triggers relative to each other. You'll see that pattern a lot. And we have a sharp point on our fib to fib oscillator. Traditionally, that's going to cause the market to reverse and at least get to a higher area, if not, really turn the trend all the way around. The final indicator that you're going to see on all of our charts, and you're going to see a lot of it, is what we call our T3 divergence potential. And it's going to plot these negative numbers on your chart, and it's going to be responsible for plotting either cyan on the bottom or magenta dotted lines on the top. And what this indicator is based on, and you have to keep in mind, obviously, with Nexgen being over 20 years old, one of the things that we did way back in the day was look for divergence at Fibonacci resistance. And again, divergence is pretty simple. It just means that whatever indicator you're looking at was lower at a time when price actually went higher. So, and again, it's kind of a measurement, if you will, of the difference between how much percent retracement was here versus how much was here. So what you'll end up with is, and again, you don't have to really know much about the indicator itself. What you really need to know is what to do with the indicator that's on your chart. And again, once we reach Fibonacci resistance, we're going to have a combination of a lot of different factors. We're going to have, first of all, reading our trigger lines. Did the trigger lines break through the Fibonacci resistance? And the answer is no. However, our synthetic triggers are up strong. So we're probably going to get one more push back to the upside. Now, because the triggers and the price didn't break the fib, and we had this negative number 38 divergence. And again, don't worry about the size of the number. Any negative number is a divergence, and it'll plot for you, so you don't really have to worry about figuring it out too much. If there's a negative number and there's a pivot, it's going to draw this magenta dotted line. Now, this adds power to this area. It means that initially we had resistance, And initially, the triggers didn't break through. So remember the concept that we introduced just a little while ago, a pivot stop out? Now, this adds power to, our ability to go counter trend trading. Obviously, our traditional trend trade is long when all the triggers are going up. Now, once we reach a key area, and you'll see we've had a prior divergence and none of our trigger lines have broken through, now we can incorporate that same thought process on a pivot stop out. So we have a pivot stop out of Fibonacci areas, right? And prior divergence highs as marked by the magenta dotted line going sideways. So at this very moment, right here, we really, really, really have a high probability of the market going to the downside. And again, you'll start to see as we work our way through our trading plan, if you've got negative numbers of divergence on not just your 14-2 chart, but your 5-1 chart and your entry chart with the market flow, then you really start to build the thought process of this area is going to be an absolute. It's, if it breaks and turns blue, sure, we'll keep going long. If not, we're going to use the multiple lines in the same area. Sometimes it's 2 or 3 Fibonacci areas in the same area. We're going to use prior divergence highs and lows as entry spots. Obviously, if we're at a spot for going short. And the other thing that we'll be able to use it for, and as I kind of back out just a little bit, you'll see down here at the bottom left, we had a divergence low, right? So again, you start to see all the concepts coming together. We had a big gap back down to the synthetic triggers that got filled, and a divergence low, and the market went back up from that spot. And again, the market goes up and the small triggers are above our synthetic triggers, and we hit green mid bands and we look for long trades until we get to resistance. Once we reach resistance with divergence, we have to wonder, is the party over? Now the market does go back up, and again, it's on this retest of a divergence high as dedicated by the magenta line. With more divergence working, this is where we really, really, really excel at counter trend trading and going short. Now, if you recognize, these as significant pivots, you'll see over here, the market literally went up almost $700 a contract from this last divergence low. So you'll see the same concept over here. This would be a fantastic target, right? So what happens is if you went short and you reached a prior divergence low, you can also use that line as a profit target. So in expecting, again, you can see it's really a pivot stop out of that last low just by a little bit, and then it bounces up. Now, of course, it bounces up, but you're going to be really good at reading your trigger lines now at this point. So you're going to recognize that your synthetic triggers are down, and you're going to recognize that your small triggers are way below them. And you're going to start thinking about, hey, where can I start taking the next trend trade short? Because we can read not only our fibs and triggers, but now we've got divergences to help us out. And you can see as we reach that mid-band resistance with the potential for divergence, the idea is that we're going to make it down to Fibonacci support. And again, as we trade down into Fibonacci support, you'll start to recognize that if you've got negative numbers working going into support and the trigger line's not really breaking through, that support traditionally is going to start holding for us. So again, you'll start to really work through the process of seeing where your triggers are relative to the other triggers, right? Small versus the synthetics. Then when you reach Fibonacci areas, you'll start to recognize, the trigger lines didn't break through the fibs and we have divergence. Then you'll recognize pivot stop outs at the edges at Fibonacci resistance for the first attempt to go the other way. And then you'll recognize, again, the trend is down and the synthetic triggers are down and the small triggers are below, so resistance areas hold and take us down to support. And then you'll finally get to support and you'll recognize, again, the potential for divergence and the fact that none of your trigger lines broke through support. So that's a really good opportunity for, the thought process of maybe starting to think that the trend's going to go the other way. And you can see obviously it does with, and this is from Thursday, so I'm making this on Sunday. So you can see this is really what we deal with on a day-to-day basis. And the more time you spend with this, the more comfortable you'll be. Look at what happened over here. We got back to resistance. Well, it's the same exact resistance as over here. Over here, we had divergence and divergence pivot stop outs. At the resistance this time, you remember that really strong look of your trigger lines? And you know what happens when you get that really strong look. The Fibonacci area usually breaks. So again, just, there's multiple tools that we use, right? And we also have a synthetic version, so we can plot these major lines from our 14-2 chart right on our 5-1 chart. So not only will we have divergence and Fibonacci areas from our big chart superimposed on our little chart, we'll have the triggers and we'll have really a complete package. When we look at both of these charts, we'll be able to know exactly when to get in, when to get out, when to stop trading in a long direction, when to start trading, short, and when to start trading long again. And finally, the last indicator that you're going to see a lot of is our T3 market flow indicator. And the short version is this is part of our trading plan right here. The market flow indicator and the market flow automated entry helps you time your entries at areas. Again, I want you to keep in mind and I want you to understand the thought process. When we look at our larger charts, and this is really the full package right here, you end up with these Nexgen dynamic Renko bars smoothing out price, which gives us a very clear, very broad view of whether we're going up or whether we're going down. So we use the large chart to say, hey, we're going down, and we're probably going down to Fibonacci support at 62.34. Then we're going to go in and we're going to look at our 5-1 chart, our smaller chart. And, again, whenever you're about to place a trade, you have to, what? Read your fibs, read your triggers, and obviously we have a lot of rules inside the plan for when and where we're going to do that. But it should be pretty obvious that, somewhere around this area is where we'll start thinking about short trades. And once we actually have the rules met for a trade, and again, this is, the market flow should, for all intents and purposes, be ignored unless we have fibs that are supposed to hold for sure based on our trigger line and divergence reading, or we have a very strong trend with an entry area. And then what we'll do is we're going to look at our market flow. Now, there's a couple of different patterns that happen in the market flow that we use a lot for entries. So what we call antenna looks, essentially what it is these two little black lines are representative of high volume areas inside of the bar. And what happens is with the range bars, and again, remember we're using a 5 range chart to help us pinpoint our entries. When we're looking to go short, we can have this bar structure happen and then we'll take a short position. If we were to anticipate a long trade from Fibonacci support, the same look, these two little black lines are the high volume area, the bar goes down and then it reverses to the upside, that would be a long signal for us. So again, it's literally just the bar structure itself, and for really lack of a better descriptor, it looks like a TV antenna. Now, one of the other paint bars that you're going to see is a white paint bar with multiple dots. So green dots represent more buyers in a bar at a particular price. Magenta dots represent more sellers at a particular price. And the white paint bars are used to denote a volume breakout to the upside. So you can see right here where we have the white paint bar, we have more volume going up and breaking out from prior bars. So it's just a warning that, potentially the market could go up. Same thing over here. Obviously, we have a lot of Fibonacci resistance, but this is where the volume really shifts to the downside. And again, what we're trying to do is we're trying to determine which Fibonacci areas are going to hold or break based on triggers and divergences. Then we go to our trading rules. And then once the rules are met, then we look for a market flow pattern. One of the other patterns, again, that we'll use, and you'll see this, you'll get a white paint bar down, but it will be into an area that may be going up. So if you get a white paint bar down with magenta dots, and the next bar is a reversal bar to the upside, that will be a long signal for us. And then again, you'll see as we reach the edge of Fibonacci resistance, we have an antenna bar, which takes us back down again. And then as we pull back into Fibonacci resistance, with all of our trigger lines going down, you'll see we have a white paint bar up, but it's not really a long signal. It's the next bar down will end up being a short signal for us. And then the final pattern that you'll see is a yellow paint bar inside the market flow. And the yellow paint bars are pretty simple. It just means that you had a volume reversal, which means nothing more than you had, let's just say, a couple magenta dots going down, followed by a couple green dots going up. Now, obviously, if you're at Fibonacci support and the triggers haven't broken through and you have divergence, this bar is going to be an entry signal for us. So again, when you're entering the market, and again, as you start working your way through the trading plan and, again, start working your way through the rules, we'll just take a quick peek at the rules and then we'll go look at a chart. The trading rules for trend trades are pretty simple. We want the large chart to be helping us, strong triggers helping us. We want the smaller chart to pull back to fibs and mid bands and have the triggers in the right direction. We want the fib to fib oscillator to be right. Then we're going to go through a check of where are the small triggers in relationship to the synthetic triggers, as you've already seen. And then we're going to say, again, what type of move will we do a second trade? What type of move will stop doing trades? And then, again, always making sure trigger line location is our top priority. Once you work through understanding the rules and when and where to get in and out, then we'll start working on management. And the management of trades, once you read your fibs and triggers and divergences correctly, will become pretty easy. If the market looks like this, for example, this is what we're looking at. This is a high probability look that Fibonacci resistance is going to hold. And again, it's predicated or based on what? Small triggers are down really strong below the down strong synthetic triggers, which, again, that look breaks fibs. So once fibs break, we'll anticipate that they are going to hold and we can start doing short trades. So until you get an actual trade setup, you don't even look at this chart, which is our market flow chart. But the market flow strategy itself has a couple of different options. And again, you can see the same fibs and triggers superimposed on here, but it's obviously a different bar. So you have a couple of choices with the market flow. You can wait for it to get to the spot where you're anticipating a trade to happen from. And then when you get to the spot, all you do is turn on these two sell buttons. And again, you have to, I predicate this with you have to know what the right spot is by reading your fibs and triggers. So again, the trading portion of what we do doesn't really come into play until you've studied reading your fibs and reading your triggers and understanding the rules and knowing where and when it's appropriate to turn on the strategy and wait for an entry. There is a second option which is available to you, which, again, this is, there's a certain situation where we may want to just place an order directly at the spot where we want to go short, or maybe a tick below it or so. And, this would be a situation where only when we have very, very, very strong trigger lines in very strong areas and no divergence prior to that would we have the opportunity to be able to allow the system to just, or place an order at a spot and allow the system to get us into a position. So again, you can see pretty clearly that, 58 is our Fibonacci resistance right here. So again, two options for entry. Number one, you can just get in at the spot. Or number two, when you hit the spot, you just turn on the market flow like this, and then you wait for the reversal bar. And what will happen after you get the reversal bar is you'll be able to, it'll automatically get you into the position. The perfect look with our triggers. Let me show it on this chart. You can see this is a really perfect look for us for going short. So, again, there's a couple of places where you will be in at the spot a little bit more assertively. And then as the trade progresses, once we start getting down bars, we're going to teach you how to manage your position and actually take your stop. And, really you're going to risk no more than the upper part of the reversal bar. So once you get a bar down on your big chart or 5-1 chart, you're able to reduce your risk significantly. And, again, the target obviously is for us to be able to make it down to Fibonacci support. So as the market works its way down towards Fibonacci support, these are the times where, again, reading your fibs and reading your triggers becomes very, very handy. Because once we reach multiple time frame support, as we showed you, one of the things that we're going to do is we're going to watch for potential divergence. Remember that? So if we have the potential for divergence, we, obviously don't want to stay in that position much longer. So if the divergence actually happens, right, which would be signaled by what? It would be signaled by this bar actually making an up bar. And you can see we've got this reversal bar marker for our 14-2 chart. 62.61 over here, 62.61 over here. So again, we might think about the potential of, if we hadn't already hit fibs, maybe a pivot stop out. You can see our divergence lines, maybe another short trade. If the market had gone up to here and then back down again, which it didn't. It actually went from resistance down to support. So with potential divergence, and as we work our way forward through this, you'll see we end up with actual divergence that will happen on our chart. And these are the things that we'll be doing, in class, and you guys will be doing on replay, and you'll learn through practice and replay and participation in the class where to get in, when to get in, why to get in, how to get in. And you can see, obviously a significant number of blue Fibonacci lines down here. And, you can see initially the triggers are down strong, so we're not going long here. Really where we would think about the potential of going long is, again, if we retested this area a second time with divergence potential, then we'd have a much better chance of this low actually holding and generating long trades for us. So you can see if you allow the, again, all I did was wait for a retest of a divergence low with Fibonacci support and allow the automated market flow system to just generate a signal for me. And again, when you get comfortable trading from the edges, you end up with, again, very small stops. And, again, if the market makes it back up to Fibonacci resistance, which is always target areas for us, right? I'll just leave that alone. Then you end up with, the ability to manage and, obviously get your risk up here. But you'll see, on a day-to-day basis from what we do, 2 trades. And, this is a perfect representation of both of our trades. One of them is going to be a trend trade with everything going in your favor, which I think is pretty easy to see. And then the second trade that you're going to end up doing is going to be a counter trend trade from multiple time frame fibs, from divergence, and really be able to take advantage of the market going either way. So when we go back and look at, the real world here. So this was the look of our large chart when we were doing short trades. And this, obviously, is the look of our large chart when we start thinking about doing long trades. And already you're saying to yourself, hey, wait a minute. That was a big gap back to the synthetic triggers. Right? So you're able to start reading the fibs and reading the triggers and saying this, 3 or 4 time frames of blue Fibonacci support with this large gap really creates a high probability long trade. Then you add to that the fact that we had divergence at the bottom at the fibs first, and then we had a second divergence at the fibs, and the small triggers were higher. And you remember, fib to fib oscillator was also higher. You start building the case for a very, very successful counter trend trade from the multiple time frame fibs. Literally, this is it. This is what you will be doing every day. Trading with the trend, 2 Fibonacci supports and resistances. When the support and resistance say it's going to hold, you'll do counter trend trades going back the other way. And ultimately, in the end, our objective for you guys is to be able to make $400 per contract or $800 per 2, or, again, as you guys will see in the trading plan, this is really our goal and objective for you. $400 per contract per day, which is a very realistic expectation. Once you can do this consistently on one market, then you can work your way into more contracts. And obviously, if you're trading, 2 contracts and making $400 a day, you're going to make more money. If you make $400 a day and you trade 10 contracts, over the course of 20 trading days, you're going to make $80,000. Again, I don't want you to get too far ahead, because before you ever trade any live money, you've got to really go through in our plan, and you've got to perfect, these things. Let me go to the last page here for you. You've got to really, really get good at recognizing the right setups, right? So you have to know when the triggers and when the fibs and when the areas are going to hold and what the rules are. Then you have to fine tune your entry execution, and then you have to fine tune your management of the trade, which we cover all of this in the trading plan. And then finally, you're going to practice the rules on a simulator. And you're going to do it over and over and over and over again until it becomes second nature to you. Once you have done that, then you've really earned the right to make real money. So again, our objective for you guys is to get to this spot right here. To be able to make 400 a day per contract, to never risk more than or attempt at least to risk more than $100 on any one trade. So most of our trades average about $60 risk. We're going to get you to the point where you're 100% self-sufficient and responsible for your own trades. You've proven through your own practice and your own simulation and your own real-world experience that the trades work and make money. And most importantly, we're going to make sure that you're 100% comfortable with your trades. You know what to do, when to do, how to do it. And, finally, the final piece to the puzzle is going to be logging into our trading room. So when you log into the educational room, your salesperson should send you out the password to this. In this room, I'm going to actually broadcast my charts. We're going to talk about trade setups. We're going to do lessons live. You're going to have the ability to post in pictures of your trades and your setups and your management and ask questions and get feedback. And really just make sure that you have done everything that you needed to do according to the trading plan. So let's get to work. If you haven't yet, filled out a demo form, fill out a demo. We'll get you software. We'll get you everything that you need to be successful. We'll get you into our class. And bottom line, we'll get you involved in the markets, doing very confident trades with the trend and even more confident trades against the trend. So let's transition and spend a bunch of time talking about the different types of trend trades that you can do. There's only two trades that Nexgen teaches, with the trend and against the trend. So we're going to use the knowledge that we've learned on reading our fibs and trigger lines, and we're going to put together a few simple rules to give you some high probability trade setups. The first thing that we're going to do is we're going to define trend. And we're going to make sure that we can define high probability trends. In the following picture, you see a trend change from green to red background color. You see wides 14.2 triggers cross to the downside. Price stays below the 14.2 reversal bar marker. And it's a very perfect look for a trend trade short. In this picture, you see the exact opposite. We had a trend change to the upside. We had wide 14.2 triggers crossed up, and price stayed above the 14.2 reversal bar marker. This is a perfect look for a high probability trend trade long. In this picture, you'll see the exact same thing. However, there's one subtle difference. When the trend changes to the downside, there's a large gap between the synthetic triggers and price and small triggers. Typically, this happens after a strong trend change. So if you had a very strong trend up, the distance back to the synthetic triggers will be a little greater. Or conversely, if you had a strong trend down, you'll see in the next example, we have this same large gap. Traditionally, the first trend change after a very strong trend up or down will produce a slightly larger gap between the small triggers and synthetic triggers. And you want to be aware of the width of your small triggers and expect a little bit more retracement before taking your trend trade short. In this final example, you'll see the same thing. Following a strong trend to the downside, we finally had a trend change back to the upside. When we made this trend change to the upside, you can see the larger distance or the big gap back to the synthetic triggers that are wide up. Again, it's imperative that you recognize not only which direction the market's heading, but how much distance is between the pivot and your synthetic triggers, especially after a strong trend either up or down. This larger gap traditionally will be filled before you start taking easier long trend trades. In this example, you'll see we have an existing trend to the downside. However, our small triggers are now physically above the wide down synthetic 14-2 triggers. We still want to take trend trades if the areas that we can trade from, such as Fibonacci resistance, are very close to the 14-2 reversal bar marker. So again, if the small triggers are physically above the 14-2 triggers that are down, and you do not exceed the 14-2 reversal bar marker, we can take one more trend trade short. Now, once we close the gap back to the synthetic triggers, as always, as you learned in our fibs and trigger line reading section, what happens at the synthetic triggers is going to be very important. So it sets up, number one, a first profit target for you. And then if the market reverses from that trouble spot for the downtrend, the market can sometimes reverse and start a new trend in a new direction. Sometimes you'll have a trend change that involves a very strong push of both the small trigger lines and the synthetic trigger lines. So when the market makes a retracement, the small trigger lines are for sure going to be below the synthetic triggers that are wide to the upside. As long as we do not violate the 14-2 reversal bar marker and we have sufficient Fibonacci support or resistance or mid bands to trade from, we're going to look for a trade as close to the 14-2 reversal bar marker as possible. And again, same thing applies when you're trading from underneath the 14-2 synthetic triggers. The 14-2 synthetic triggers will become your first profit target area, and what happens at this area will be very important for what happens next. I want to introduce the same concepts when you're looking at your 14-2 chart. If you have a very strong trigger line push to the upside, and your small triggers get below the synthetic triggers, as long as the synthetic triggers are still crossed up, you're going to get one more push back up into the synthetic trigger lines. Now, same way we looked at on the 5-1 chart, what happens at the synthetic trigger lines once reached is very important. So we're going to introduce an additional indicator, which you remember as our T3 divergence potential. If that push back into the synthetic triggers also has divergence, you have a high probability of a reversal in the market. Once you have the reversal in the market, you'll see we end up with two looks that are very good for trend trades on our smaller chart. The first circle has price below our 14-2 small triggers, and the second trend trade short has price above our 14-2 triggers. And to add just a little bit to that, you'll see that once our small triggers are well below the synthetic triggers, if you make a retracement in price and you have divergence, again, that look will typically fail, and that's the type of spot that we would want to do short trades on our smaller chart if we had the correct area. So let's take a look at these two charts together so you can see how the relationship works. On your large chart, 14-2 chart on the left, you'll see we've got a strong push up. I'll draw a circle. And then we get one more bounce to the upside because of the strength of our synthetic trigger lines. After the push up to the top, you can see we have a negative 68 number. Now again, this, initially is not as important for trend trades on our smaller chart. However, you'll see that with the strong push to the downside here, this is what causes the trend to change on our smaller chart. Not only does the trend change on our smaller chart, but you can see we've also introduced a concept of no divergence on our smaller time frame chart. So I'm going to add one more little piece to this right here. So we have a couple of things as we start to layer in reading of our fibs and trigger lines that are going to generate high probability trades for us. Number one, with our 14-2 chart, we've had the small triggers get below our synthetic triggers. We've had a push back into our synthetic triggers. We've had divergence and down bars on our large chart. And as the market's gone down, we have very strong small triggers to the downside. Now, once we have that, that's a high probability of a top. Reading our fibs and trigger lines and divergences. Actually, no fibs yet. Now, once the market goes down and changes trend on our smaller chart, which is represented by the small triggers here, you'll see we end up with really what is our perfect look for a trend trade down. Wide 14-2 triggers cross to the downside, a trend change with no divergence on the low down here, not too much gap between price and small triggers and the synthetic triggers. And then, this is really where we look for very high probability trend trade shorts. Now, as the market trades to the downside, you'll see that we put in divergence. So we've got a negative 68 down here at the bottom. Traditionally, when you have a divergence, that means that the market's going to go back up higher, and many times will stop out of pivots before you actually make the move to the downside. And again, once you get to a spot like this where we've got the large gap right at our synthetic triggers, if you've got the proper Fibonacci combination here, maybe you get one more attempt at a short trade. If not, then traditionally the trend will just about be over. And again, just, if you did do a short trade in this area, again, what happens once we get back to the synthetic triggers is going to be vitally important. If the market doesn't get through the synthetic triggers and starts to reverse to the upside, many times you'll change the trend. Now, again, as we start to walk forward, you'll see what happens. We get a trend change. And again, in reading our small chart alone, right, this is where people say, oh, I want to do a trend trade to the long side. And you can see it's a good look. Trend trade changes to the upside. Just small triggers and trigger lines alone here, you'd be thinking long trade. However, when you add in from the large chart this divergence and the location of your small triggers well below your synthetic triggers on the 14-2 chart, you end up with a lower probability look over here. So again, it's imperative to, number one, pay attention to your 14-2 chart, obviously. And again, the rules are the same regardless of the time frame chart you trade. So if you have divergence, you're going to make a retracement. If the triggers are still up, you're going to make another push. If during the push you have divergence and the market fails, you usually end up with a reversal to the downside. Now, short-term triggers go up, but location of the trigger lines relative to your synthetic triggers tells us what? That the probability is that the market's going to go down. When we add divergence potential to that, and then if we had Fibonacci resistance or something like that at the same negative 32 spot, we really start to build the case for the market not going up much further. And really not having, just because the small triggers are up, a high probability long. what we end up with instead is the market going to the downside. And if I remember correctly, we had a couple of opportunities, 2 or 3 opportunities for short trades that were very, very well received. All right, so let's tie all that together. So again, what I'd like to do is have you take a look at this 14-2 chart. And again, we've got divergence at the top that, again, strong triggers up. The market makes a retracement. The market retests the synthetic triggers with divergence. And really, this is all the pre-setup for us for a full, trade setup. So all of those things come into play, and then we get the opportunity to actually take a look at our smaller chart and, really kind of pull all of the pieces together. So let's take a look at our smaller chart. What do you see? You see, again, I put all the indicators on here. Multiple time frame Fibonacci resistance. Again, let me show you our trade rules here. And again, this is the type of thing, I put these in your folder on your desktop, in your Nexgen folder, so you can copy paste these on the chart. It's always nice to copy paste the rules on your chart. So let me make those a little smaller. So let's go through the rules. Okay, for a trend trade, I always like these little reminders. You're patient, you have a goal, you're looking at your trades in both charts. Do you have high probability or low probability? If you have a high probability trade, how are you going to enter that trade? Where are you going to enter that trade? If it's lower probability, right? So high probability versus low probability. And the low probability for us is 50-50. So I don't want you to think like 20% chance of winning. So, we can take lower probability trades, but they still need to be 50-50. So trend trade rules, very simple. 14-2 triggers crossed in the trade direction that are wide to the downside. Very easy to see right here. It paints the background color. Now, once we have our background color, we need price, the bars themselves, to actually touch Fibonacci resistance and or mid-bands and or prior divergences. And if we can get all of those things in the same spot, that's really a bonus. Our Fib to Fib oscillator needs to be in the upper 25%. For shorts, obviously the lower for longs, but we're looking at a short here. So, and then we want to look at what happened before, right? Where are the small triggers in relationship to our 14-2 triggers? Are they below it? If they're below it, we're going to be looking at the spot for an entry. And the closer to the spot, the better. Then, this is the spot where you turn your market flow strategy on. So the other thing that we want to look at is, prior results. Where did we come from when we got up here? Did we have divergence on the lows? Did the 14-2 chart hit an area that says this area is going to hold? If those things are not true, then we have a really high probability trend trade short. And again, when you focus in on looking for high probability trend trade shorts, the other thing that you're going to think about, as you're getting to prior divergence and resistance and mid bands and triggers is where we're going. We're going to go from resistance down to Fibonacci support, assuming nothing gets in the way. Get in at resistance and you work your way down to support. We'll take a look at the numbers here. So 63.73 down to 63.43, pretty easily $200 to $300 potential between the targets from Fibonacci to Fibonacci. And again, focusing in on high probability trades that have plenty of room to the next Fibonacci support, making sure that there's, room to your targets, right? $200-$300 to your target, at least, 15 ticks before you run into trouble. And again, really important to make sure that your triggers are situated properly, your fib to fib is right, and there's nothing in the way between you and your target. That's really the definition of a perfect trend trade. If your small triggers are down strong and your synthetic triggers are down strong and your small triggers are below your synthetic triggers, we're going to sell the pullbacks. So as long as this trigger line configuration remains, we're basically going to sell the pullbacks. So we'll do trend trade short on our little chart, trend trade short, trend trade short. Eventually, you're going to hit multiple time frame Fibonacci support. Two things are going to happen. Number one, if you're in a strong trend down, you have to wait until your triggers roll up because maybe you break it. If you hit multiple Fibonacci support and the triggers don't break below it and your trigger lines roll up, we can start doing trades going the other way. So we're going to buy dips in the market with our triggers going up, and we're going to look for trend trade rules to be true on the small chart. If the trigger lines continue up and break above fibs in areas, we're going to buy the dips. We're going to go trend trade long on our little chart. If the triggers continue up strong, we're going to buy the dips again. Look for trend trades on our little chart. If the triggers continue up through fibs, we're going to again buy fibs on our charts. Now, notice that your small triggers are inside of your synthetic triggers going up. That's a high probability that this fib holds and gets you up to resistance. Once we hit multiple time frame resistance without the triggers breaking through, we then have the opportunity to do what? Potentially go the other way if you're a counter trend trader from the multiple fibs. If you're not a counter trend trader, that's okay. You're going to wait for the triggers to break down, be strong below areas, and then you're going to buy the pullbacks, or sell the pullbacks, excuse me, with trend trade shorts on your little chart. So you're going to do trend trade short, maybe one more trend trade short, and then you're going to stop because you hit a fib. After your small triggers break through, you're going to do trend trade short again until you get to multiple fibs. And then, you know, your areas are going to, this is overnight, midnight, so it's a little messy. And then you're going to see the difference, right? Again, same thing. You hit multiple fibs, the edge, triggers don't break it, short. You also have fib support for a long. And then you have multiple fib resistance for another down. So if you're doing the edge trades, this is 3 opportunities for edge trades. If you're only doing trend trades, you're going to wait for the small triggers to go down strong, and you're going to continue selling pullbacks using the trend trade rules on your smaller charts. So over this 2, 3, 4, almost 5-day period, you know, assuming that you take $200 a trade, you have the opportunity for $200, $400, $600 on trend trade shorts, and then $800 as you start going long, $1,000, $1,200, $1,400, and then if you do counter trend trade longs for shorts for $200, $1,800, $2,000, a pullback for another to get you to $2,200, another pullback for $2,400. Now we're going to spend some time talking about location of triggers and, more importantly, when you're going to stop taking trend trades in the direction. What I'd like to do is just walk you through the chart, and we'll talk about the different types of looks and the different things that you will see on your 14-2 chart that will cause you to either take a trend trade or stop taking trend trades. So the magenta lines that you see up here, I'm going to just draw a little square in for you. This is a prior divergence line. If and when you reach a prior divergence line and you start trading back below it, no more long trades. Because almost always you get a little bit past it and then they turn around, and this is, obviously what we call our pivot stop out. No more long trades. And you can see, and this is a situation where we had the edge of Fibonacci resistance, which is always a good spot for us, combined with a prior divergence high. And then once you start trading below, all of these trades in this area, and again, it's going to be tempting when you look at it because you're going to say fibs and triggers and everything else. Again, just when you have a prior divergence high or low and you get just past it and back below it, don't do it. Now, the trade that you would want to do, strong triggers coming down and Fibonacci resistance and price below, obviously that's going to be a real easy trend trade short for us. Then as the market trades down, you're going to reach Fibonacci support. And once we reach Fibonacci support, you're going to start off with the thought process initially that there's a large gap back to the synthetic triggers, which would be true. So at this spot, and again, I'll just draw a box in here, this is the spot where you would stop doing trend trade shorts for the moment, expecting the market to make a bounce. Now, it did bounce, didn't quite close the gap, and then resume the trend. And again, as we bring back in lessons from our trigger line reading, you remember what happens if our small triggers break below a Fibonacci support and can't get back above it. That's right, Fibonacci support breaks. And again, for us, for trend trade shorts, this is not our trend trade short area. This whole area right here is just, we're waiting for something to be very easy for us. So when our triggers break below and the triggers are rolling down, we have these pullbacks, and this is the spot where trend trade shorts are going to be easy again. And again, you can see really, really strong triggers down here, both of them. And you can see this is a case where we pull back to Fibonacci resistance with the strong triggers down. And again, same thought process here. If we get back to a prior divergence low, we're going to watch that low, and if we start to get back above it, we'll stop doing long trades. Well, sometimes the market doesn't stop, right? So the market continues down, and again, strong triggers down, pullbacks, we're going to continue to do short trades. Now, at this moment in time right here, we hit Fibonacci support, and none of our trigger lines break through Fibonacci support. Stop doing trend trade shorts at this point. And we're going to wait for one of two things. The market to either roll back up above Fibonacci support and the triggers to get back above the synthetic triggers, or we're going to wait for support to break. And you can see this is about 3 in the morning right here. They do break a little lower and then back up again. Now, I want you to notice at this moment in time, right here, I'm going to draw a circle. Now you have Fibonacci support and your small triggers are physically above the synthetic triggers. So again, this may be your first attempt at a long trade from Fibonacci support. As the market trades up, again, triggers break through the mid-band. So we're going to continue to do 1 and maybe even 2 more trend trade longs until we reach a resistance line. And again, our 165 EMA can be resistance. When you reach this resistance line, what's the first thing you notice? Of course, you're going to say it. I'm going to show it to you. It's going to be a big gap back to your synthetic triggers. And again, with a big gap from a resistance that holds, no more long trades for us. And again, if the small triggers are really strong, we can actually take a short trade. So we're going to get a short trade trying to close the gap, at least 20 ticks worth back to the synthetic triggers. Now, as always, from the wrong side of our synthetic triggers, if you reach that spot, again, there's a couple of things that happen here. Number one, the background color has changed green and our synthetic triggers have crossed up. Do you remember in our trend trade lesson that if there was a strong trend down and the market changes trend and there's a big gap back to the synthetic triggers, that the market will usually close that gap? And then what happens at the synthetic triggers is very important. If the market puts in divergence, which you can see, and the market reverses from the synthetic triggers, no more short trades. Really, that's a spot where we'd look for long trades. But we're not talking about counter trend trades yet. We're just talking about trend trades. All right, strong triggers going up. We're going to do a trend trade long right here. Very strong triggers going up. This is where the large chart is helping long trades. Now, once we reach resistance with divergence, again, that's a good spot to stop doing long trades. Now, because we hit, again, this is our trend trade rules, isn't it? So if we have a trend trade look on our 14-2 chart, and again, it has to be a really good, trend trade look. So what are the rules? Synthetic triggers crossed up, price touches fibs and midbands, fib to fib oscillator, still the same rules, just a bigger chart. So this is a trend trade long look on the 14-2 chart. So if, before we reach that area, you had taken maybe one short trade, when you reach that area, you're not going to do any more short trades because we're expecting the market to bounce back up. Why? Because fib to fib oscillator, trend trade long look, and again, you can see we've reached or headed up towards Fibonacci resistance. Now, this top incorporates pretty much everything on the planet that we say stop taking long trades for. Multiple time frame Fibonacci resistance, divergence potential, a pivot stop out of a prior divergence high. Everything pretty much says stop taking long trades here. And you'll see the result of that move to the downside. And again, once you get that move, obviously we get short trade opportunities if you get them. And same rules apply. Stop doing short trend trades if you get a pivot stop out of a divergence line and you get back above it. Just stop it. Don't do any more short trades because you're probably going to lose them. The market's probably going to bounce back up. Well, you can see what happens where the market bounces up too. Perfect trend trade short rules. And again, I'm not saying you have to take a trend trade short on your big chart, but when you have a perfect trend trade short look on your big chart, usually those are the perfect, there's a couple of perfect looks that we have for counter trend trades on our little chart. And they usually entail divergence pivot stop outs at fibs, and they usually entail trend trades on the big chart. So I'm planting a seed for later. Again, walking forward through the chart, very, very obvious here. Multiple time frame Fibonacci support, no triggers break through it, and divergence potential. We're not going short anymore because short trades will traditionally lose, and we'll start looking for potential long trades if we can get our hands on them. And we'll continue to do long trades until we reach prior divergence highs. Now, one of two things is going to happen at a prior divergence high. We're either going to break through it, which is fine. And if we do break through it with our small trigger lines considerably, we'll do more trend trade longs. And obviously you can see the outcome of the market going up really, really strong here. Now, this was the edge of our Fibonacci resistance, and our triggers broke through it. So again, if, just to kind of expand this out, once you break past it, we're going to get one more trend trade long. Now, again, this goes up, and you have to really kind of keep perspective on this. The low in here around 87 up to the high, there's easily 20 ticks in there. So again, this is a look on the big chart that's going to be very advantageous for us to work with for long trades. And then again, sometimes they overrun the edge of fibs and then the small triggers get back below it. Again, you remember the chart that we talked about when we talked about trigger lines. I'll introduce it again for you. Sometimes you get to the edge of fibs and the triggers overrun just a bit. Remember that? And then when the triggers get back below it, the fibs, you can use them. Well, same logic here. Small triggers break above. However, small triggers break down really strong and potentially start doing your first short trades. And again, same thing holds true. We get back to potentially a trend trade long spot. And you're going to say to yourself, well, John, there's a big gap back to the synthetic triggers that are really far up. And you'd be right. And that's the type of look that we want to see, for, again, the big gap getting closed, really strong triggers going up, trying to get back to the synthetic triggers, at which point we'll make some decisions. Right? Are we going to break through and keep doing trend trades, or is it going to turn around? Well, you can see the answer right here. The triggers got really strong and above the other triggers, so this is going to be a very helpful look. And we're going to continue looking for trend trades until what? Until we get to resistance. Once we get to resistance, we're going to go through it, it looks like. And again, this is another trend trade long opportunity that we're going to be looking for because of the strong trigger line look on our 14-2 chart. And again, we're going to look for yet again another trend trade long. So again, just to keep it in perspective, 20 ticks, 20 ticks, 20 ticks, maybe 20 ticks here, and then we reach multiple time frame fibs. And again, when we reach multiple time frame fibs, we just stop trading. We're no longer looking for long trades, but we also recognize that the trigger lines are very, very strong. So if we get through it, maybe we get a trade. If the market rolls over, gives us divergence, and gets back below it, we'll start looking for short trades if we can get them. Didn't look like it pulled back for any. Now, you're going to recognize big gap again, right? So again, at some point, you're going to say, look, I've hit a mid-band. I've got a big gap. I'm not going to do any more trend trade shorts for the moment until we bounce. And then when the market bounces, you'll recognize that same look that we love to see. Small triggers way below our synthetic triggers and divergence going into multiple time frame resistance. This is the type of spot that will take the market back down again. And again, as the market goes back down, you'll see what happens. We get to multiple time frame Fibonacci support, at which point we will stop doing trend trade shorts. So if we do any shorts in here, shorts are over when we reach Fibonacci support. And again, strong move up off of the support, strong triggers up, getting above our synthetic triggers. What are we going to do? We're going to do one more long trade until we get to resistance, until we get to prior divergence. And then we're going to allow the market to dictate to us what's going to happen. You can see with a little pivot stop out, so we'll stop doing longs until what? Until we break through or get back below here. And you can see obviously the market took off to the upside. And again, you can see very, very, very strong trigger line looks. These are the types of pullbacks that we're going to look for trades to take us to the upside. And you can see, obviously, the market did go considerably to the upside. Trend trade long look. First violation below the synthetic triggers. And finally, a second divergence with a pivot stop out. We're going to take a short trade right here. We're going to stop doing the short trade when we get to the fibs. And you can see it kind of chopped around a little bit, a little above, a little below. Again, divergence with our small triggers below the synthetics. Again, really not a lot of easy setups in there, but remaining patient. There's a trend trade short there. There's a trend trade short there. There's one more trend trade there. And then you'll recognize divergence with a gap. We close the gap. And again, we just repeat the process. Strong triggers up, breaking above everything. We're going to get a pullback and we're going to take long trades. And we're going to say, why didn't we stay in that trade all the way? We're going to have one more long trade here. That's going to take us up to resistance. Once resistance holds without the trigger lines breaking, we get our pullback. The triggers get below our synthetic triggers again. And then eventually we retest the triggers with divergence and fail, which means what? We're going down again. Which means if we get pullbacks and we get trend trade shorts, we continue to do trend trade shorts until we get to support, right? And you recognize again the big gap back to your triggers, which means what? We're going to get a bounce. And we got a bounce as we expected. And you can see this is actually today, we did this in class. Trend trade short rules are here, right? Synthetic triggers down, mid bands and fibs, fib to fib oscillator. So we should be going to the downside. We actually had a couple of these in class where we were talking about short trades today. And obviously as the market goes down, we hit fibs with divergence, which means no more shorts for the moment. One more trend trade short look on our big chart. And then obviously the market continued strongly to the downside. And you can see the same process happens. Divergence finally at the bottom, and then we get back above. So trend trade long until you get to your 165 EMA, and then you'll say the same thing. There's a big gap back to our areas, which means we're going to go back down and test it. When we test it, what happens here is going to be definitive for what happens next. The final piece of the puzzle is when we start to put all three of our charts together. If we have negative divergence working on the 14-2 chart, and we have existing multiple divergences on our small charts, we're really, really, really lowering the probability that any further trend trade shorts will happen. Now, there is one exception to this. If the market was to break the double divergence at the bottom on the small charts, then we can continue trading with the trend. And it's very important to keep everything very relative. Obviously, at this point right here, we had a double divergence on our chart. However, we did have a trend trade short that ended up working. But once we actually break through this double divergence and go lower, usually divergences don't work anymore. And in this case, just let me give you a quick example here. This was the situation we were in. We were in a very, very, very strong downtrending situation. So again, this is where our double divergence happened, and you might think, okay, no more short trades. Once that's violated to the downside, then we can continue taking short trend trades as long as the market's going down really strong. So again, this is what it looks like on the smaller chart. You start off with the double divergences. You break the lows with a really strong trend down, and then you can continue taking trend trade shorts as long as the trend continues down. In this section, we're going to go through trend trades that are on the wrong side of your 14-2 triggers. Just to review, when we have a potential trend trade short and your small triggers are on the correct side of your synthetic triggers, we've already seen that we want to be in this type of trade a little more assertively. We've also seen when we're going long and we have a trend change to the upside and our small triggers are physically above our synthetic triggers going wide up, we want to be in a little bit more assertively at the first areas. And again, as a review, if the small triggers are physically above our synthetic triggers, we can still do trend trade shorts as long as we don't exceed the 14-2 reversal bar marker. And this is where we're going to do a lot of study work today. We're going to determine where the correct area is above the triggers in order to take one more trend trade short. And again, you'll see the same thing when we start looking at long trades. And again, I want you to really keep in mind, 80% of your trend trades are going to be from the wrong side of your synthetic triggers. So it's nice to say, I will just wait for perfect ones that are on the correct side, but you're really going to miss the majority of your trend trades. So it's very important for us to go through and do some study work on how to correctly identify the proper area when your small triggers are on the wrong side of your 14-2 synthetic triggers. Now I want you to think about our trend trade rules for just a minute. And again, these rules, we talk about them every day in class. For a trend trade, we want the 14-2 triggers crossed with us, which is pretty easy to see. The background color on the small chart is going to plot that. We want price to touch mid-bands or fibs or some type of horizontal support or resistance line. We want our fib to fib oscillator to be upper or lower 25%. Now this is the one that we're really going to study today, or right now. We're going to study where are the small triggers in relationship to the 14-2 triggers. We've already done the easy ones, the ones that are on the correct side. So this next section is going to be location on the wrong side. And then we're also going to take a look at prior results. We've already covered the section on what type of looks will end your high probability trend trade thoughts. We've also talked a lot about high probability looks for trend trades up or down that have very, very strong small triggers with us. So again, the strong trigger look is really the predominant number one look that we're going to look for when we're looking for trend trades on the wrong side of our synthetic triggers. So now in order to really get good at this, number one, you're going to have to go back and do a little bit of study. Number two, keep in mind, this is a 3-chart process. So the only thing that we're getting from our 14-2 chart is the big look of the big triggers crossed up and above our synthetic triggers, and the fact that we haven't yet reached any trouble spots. Once that chart is done with, then we go actually look for the rules to be met on our 5-1 chart. Again, in our trading rules, it's pretty simple. If the small triggers are physically below our synthetic triggers, we're not going to look at the first area to go long, which would be the midband. We're going to focus our attention down here on where the 14-2 reversal bar marker is. And this is going to provide for us the better spot for us to take our long trades from. And again, if you get in too early, you're going to end up taking a loser only to watch the market get to the best spot and then take or miss what would inevitably be a nice winner. Now, the third step of this process is to go down to the market flow chart. And again, when we're looking for a trend trade, all of the same indicators are superimposed on the market flow chart. A lot of times the market flow midband or the 165 EMA on the 5-1 chart is going to be helpful for us for this last trend trade to the long side. So again, once we get into this area, and again, you have to really keep in mind, the midband started at about 86 and the reversal bar marker was at 82. So that gives us a very small 4-tick window in which to operate for our trend trade long. Now, there will come a time when you're going to get this trade long, and again, this is one of those situations where our software actually updated its fibs at 8 o'clock. So we got the initial long trade. And then we ended up with a trend trade rules being met. And again, just to kind of discuss trend trade rules. Fib to fib oscillator in the right spot. Okay. Then our small triggers, they're below our synthetic triggers, but our synthetic triggers are still up. And again, this is one of the exceptions that you're going to see. You're going to have our trend trade rules met. However, you're going to at the same time have our second set of rules, which we're not really dealing with in this video for multiple time frame Fibonacci. But when you get both the trend trade rules met, and you also get to the edge of multiple time frame Fibonacci support or resistance. And more importantly, when you're at the edge of a multiple time frame support or resistance, that none of your trigger lines break through Fibonacci, and your market flow gives you an entry pattern, you're going to be able to take that trade as well. So this is the one exception, or there's a couple of exceptions, but this is the big exception for taking trend trades on the wrong side of your synthetic triggers with your small triggers below, but you're adding in a secondary rule, which is, again, you can see we've got two Fibonacci support lines here, and literally 62.93 is the edge of multiple time frame Fibonacci support. So this gives us an advantage for finding a second trend trade long. So if you took your first trend trade and took 20 ticks, again, being able to take the second trend trade from the edge of fibs, and again, if you look at our target areas, obviously our next Fibonacci resistance is our target area. So we've got literally 40 ticks or more before we reach our next Fibonacci target area. So again, one exception to not being at the last area, because if you waited for the last area, you might be thinking, where is that area? Because you don't actually even have a reversal bar marker. It's actually up here above the market. So again, trend trade long at the edge of multiple time frame blue Fibonacci is an exception that you'll be able to take with very, very high consistency. Now, to bring in the market flow chart, the other criteria for a trade from the edge of our Fibonacci support is a market flow signal. And again, right here, you can see we have a white paint bar down with a arrow and a market flow long signal. So if you were in this situation and you were ready to take your trend trade long, as you trade back down into the area, all you would do is just turn on the longs, and then when this reversal bar actually happens, the automated strategy would just get you in and you'd be in for your trade. As this day progresses, you can see we got really close to our Fibonacci resistance, multiple time frame up at the top. Then we had crude oil news that came out, and you can see obviously we made a very big shift in the market, and at this point in time we had a very, very strong down trigger situation. Anytime we have the very, very strong trigger down situation, we immediately go to our 5 chart and we look for rules to be met in order for us to do trend trade shorts. And again, this is, moderately simple. You can see this is the exact opposite of what we just did. We have the triggers on the wrong side of our synthetic triggers, and we have our initial trend trade rules met. Fib to Fib oscillator in the right spot. At this spot, you'll also notice that we are now at the edge of multiple time frame Fibonacci resistance. And again, anytime we get to the edge of Fibonacci resistance and all of our trigger lines are below the edge of that Fibonacci resistance and our synthetic trigger lines are down, we really again end up with both of our rules met. We have trend trade rules met. At the same time, we have the edge of Fibonacci resistance, and we have really everything that we need in order to take a short position. And you can see the outcome of that position obviously took us all the way down to what would have been our Fibonacci target down here. And again, there's a couple of small things to notice. The prior pivot was taken out. So anytime you can get a little one-tick stop out, that's a good thing. And the other thing that you'll notice going into that trade is that there was absolutely no negative numbers or no divergence on the pivot prior. So again, we broke support, which is good. We retested the edge of Fibonacci resistance to the downside with the trend. And anytime you can take a trade from the edge of Fibonacci resistance with the trend, it's actually a double bonus for what we do. Moving on from our last trend trade short. And again, all of this is predicated with the idea that we've got this look on our large chart. So again, it bears repeating. Anytime you have a super strong parabolic type, very, very strong trigger line look, we don't want to go long, and we want to take as many trend trade shorts as we possibly can until we reach Fibonacci support. When we reach support, then we'll have to make decisions. So again, how this looks on your smaller chart. Obviously, that was our last trend trade short, and we reached our Fibonacci target. Now, when we reach a Fibonacci target, if the market breaks through, and again, this is another situation where you absolutely want to take another trade. When a fib breaks and the large chart has a strong trend, again, let me just type the basic rules on the chart for you here. We want to have 14-2 triggers really strong with the trade direction. We want to touch fibs and or mid bands, and we really want our fib to fib oscillator to be at 75. So technically there's only two spots on this chart where our fib to fib oscillator met the rules. Now again, we talked about divergence. When you have divergence initially, typically what happens is you'll get a pivot stop out before you'll get the right trend trade. And again, this is where, because we have divergence first, you need to go back and find where the last pivot was. Once you have exceeded the prior pivot's high, then you're able to take another trend trade short. And again, this is, the first divergence that you see on your charts. Again, you have to make a decision. Is this divergence going to be a trend ender, or is this divergence just going to get you back up to your trend trade spot? And again, I can't overstate, having a super, super strong look on your large chart supersedes pretty much everything else. When you have this look, you just keep taking trend trades until one of them doesn't work. So trend trade rules are met here. And again, the market goes down and, we get into our synthetic triggers and we have divergence. Now, one of the things that we talked about just a little while ago, if you break a divergence low, and this happens almost every single time in a strong trend, Once you break that divergence low, you don't really worry about the divergence lows anymore until you reach an ultimate target. So again, you start off with trend trade short. Obviously, the market goes down. We have, again, one more trend trade short. And again, we don't quite make it back to the last areas on your chart. And again, in a parabolic, super strong downtrend, you're not going to make it, sometimes to the last areas. It's just the way it is. And again, you have to have the feel for your charts. As we work our way forward, you'll see we end up with, again, another one of these situations where we break through Fibonacci support. And, again, we didn't quite meet the trend trade rule short here. We did meet the edge of multiple time frame fibs with the trend one more time for a potential short trade. So there's a lot of our clients in class that took, this 33, 34, 35 area as a short trade with multiple time frame fibs. And then again, because the market was going down, we're still going to continue to do trend trades. So this is really where our rules were met. And again, this is really the textbook look. Obviously, these are the last areas of resistance on our chart. And you can see our 14.2 reversal bar marker up here. Now, once we get to these areas, either the edge of fibs or obviously trend trade rules met, again, we finally go down to our third chart and we're looking for entries. So the market flow, again, this is the market flow signal from the edge of resistance for us. Again, this one didn't quite fit the trend trade rules. This trade right here actually fit the trend trade rules. So all of the rules that were met on the 5-1 chart. Triggers are strong down, touching fibs, and you can see really this is the last resistance area before the 14.2 reversal bar marker, which really makes this one, textbook perfect for us for selling this area. And you can see this is the 14.2 reversal bar marker. This is the last area. And then obviously we watch our Fibonacci support for a target, which was 20 ticks away. And obviously the market really continued on down. So very, very strong trend down today. So again, this box was where the rules were met on the 5-1 chart. And this box was, and you can see both of these spots here, that was the edge of fibs, and then this one was our trend trade from the wrong side of our synthetic triggers. And then obviously the result of that really took us to the downside here. Now this same thing, once we actually reach a bottom and the market makes a bottom, we're going to start looking for trend trades going the other way. And you can see obviously we've had a heck of a day today. Very, very clear, should be very clear to you that we've made a really strong move to the upside. And it's at this point right here that we want to go in and we want to find the trend trade on our smaller chart. And again, once we actually pull up our 5 chart, again, we have to go forward with the thought that our larger chart was very, very strong to the upside. So we're going to look for another trend trade. Again, we recognize that our small triggers are below our synthetic triggers. And again, this is the first temptation right here when we get to the midband. When we look at the last support area. And again, just imagine yourself starting a box at the reversal bar marker and then starting to work your way up. And you'll see that this area right here was the last area of support before we made a down bar. So this is the spot where, again, we would take our market flow chart. And again, the same areas are superimposed on the fibs, 14.2 reversal bar marker. Again, maybe just a little exercise. Just take a box and start drawing up until you reach the first support area. And this typically is going to be the absolute best spot for you for taking your long trade. And again, once you reach this spot, again, as you're working your way down into the spot and the market's coming down to touch it, that's when you would turn on your strategy. And again, if it generated a long signal for you or an up bar, it would get you into your long position. And you can see if you got into this position at the mid-band, we ran into resistance and then we actually got down to the right spot, and then the trade actually finished itself off and obviously had a very, very big move to the upside. So again, if you get in here, sometimes you get frustrated because you got in too early. Always double check your 5-range chart. Just take a rectangle. You can use your drawing tool, go up here and go down and make a rectangle, Control F12, and just start drawing up from the 14 to reversal bar marker and say, where's my first support? There it is. That's the bingo for you. That's the bar you want to get in for your trend trade and really maximize the profit potential on every trade. In this tutorial, we're going to teach you how to trade from multiple time frame Fibonacci and from the exact edges. In this video, we're going to leverage all of the good information that you've learned about high probability trend trades and use that information to help us define counter trend trades on the smaller chart. So we're going to focus our attention on the chart on the left. So on the 14-2 chart, you can see that we've had a trend change on the larger chart. The small triggers have come down a long way, and you can see at the low, we have no divergence on this pivot. Now remember, when we have a strong trend change and there's a larger gap back to the synthetic triggers, traditionally we'll close that gap. And you can see when we do close that gap, we end up at multiple time frame Fibonacci resistance. So not only do we end up at multiple time frame Fibonacci resistance on the 14-2 chart, we also have multiple time frame Fibonacci resistance on our smaller 5-1 chart. It's at this very spot where we anticipate on the 14-2 chart a high probability trend trade short. Again, all of the rules being met. Synthetic triggers are down. Price pulls back to mid-bands in Fibonacci. Our Fib to Fib oscillators at the 75 sell line. So we really have a very high probability trend trade short look on the large chart, which will enable us to use the multiple time frame Fibonacci edge with no triggers breaking through that edge to define an exact spot for a counter trend trade. The entry for this trade is very, very simple. The first down bar that you get on your market flow chart from that edge is your entry. So whether you place a stop order below the reversal bar marker so you get in immediately, or you turn the strategy on as you're reaching the area, so any reversal bar at the area will get you in. Very simple. You have to wait for confirmation from the 5-range chart, because if it never gives a reversal bar, the market could keep going to the upside. So again, the reversal bar from the multiple time frame Fibonacci edge is the entry for your counter trend trade short from multiple time frame Fibonacci resistance. The next pattern that we're going to look at is still using multiple time frame Fibonacci support and resistance. And what we're going to do is we're going to focus our attention on the 14-2 chart on the left, and we're going to focus our attention on the yellow box at multiple time frame Fibonacci support. Now, it's not the first test of Fibonacci support. This is a high probability second test of multiple time frame Fibonacci support. So you may have had your first trend trade way back to the left. It's during the retest of this area. You've got a couple of things that, again, I want you to really understand this because it's very, very important. This pattern repeats itself over and over and over on every single chart that we have with dynamic Renko bars. Literally every day, you're going to see this pattern. So it's at the yellow box, we have potential for divergence, and you can see we've got a negative 58 there. We also have our fib to fib oscillator at the 25 buy line. At the same time, we have a large gap back to our synthetic triggers. And at the same time, our small triggers have barely made any type of retracement to the downside. So we have really a lot of pieces to this puzzle. First and foremost is multiple time frame Fibonacci support. Second is divergence potential on the large chart. Third is fib to fib oscillator making a retracement back to 25. And then the fourth and fifth pieces are the location of our small triggers and synthetic triggers on the 14-2 chart. It's at this retest or this spot at 1650, 1660 that we're looking for some type of counter trend trade to the long side. When we move over to our 5-1 chart, you'll see that during this retest of this Fibonacci edge at 1660, we have not only Fibonacci edge, but we also have a prior divergence low pivot stop out. And when you can couple the look on the 14-2 chart, which is a very high probability that Fibonacci support will hold because of our trigger lines and fib to fib oscillator, couple that with a divergence pivot stop out on the 5-1 chart, you really end up with the first counter trend trade from the edges of multiple time frame fibs that will generate your first long trade. You'll also notice on the smaller chart, the 5-1 chart, that we have a large gap back to our synthetic triggers. This is also very helpful. Now, I'm not sure if you've noticed it yet, but the exact same pattern that we had on the 14-2 chart that caused the bottom also gave us a second opportunity for a second long trade if we had exited our first long trade. So let's take a look at the pattern on the 5-1 chart. And again, you really need to learn this pattern because this pattern repeats itself a lot. So starting from the lows, the market obviously goes up, and that was our first long trade. It's during the retracement that you'll notice that we reach multiple time frame Fibonacci support at 1730. We also have divergence potential that we'll be working on the chart. We also have the fib to fib oscillator at the 25 buy line. And as we retest this Fibonacci support with divergence potential, you'll notice that we have considerably higher small trigger lines, and we have synthetic trigger lines still above us. And while it's not exactly a double bottom in price like it was on the 14-2 chart, it's a very, 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 very consistent pattern that you'll see on our software, with especially when there's Fibonacci support and resistance. So again, just to review, the pattern on the 14-2 chart caused the first attempt at multiple time frame fibs. A push up, a retracement to retest the fibs. During the retracement, 25 on the fib to fib oscillator, much higher small triggers, much higher synthetic triggers, divergence potential, and we're going up. So again, entry at 1660 on the first long trade. If you wanted to take a second opportunity with the same pattern but from the 5-1 chart, that's also very acceptable. The market goes up, During the retest of multiple time frame fibs, fib to fib oscillator at 25, both the small triggers and the synthetic triggers considerably above multiple time frame fib support at 1730 creates a fantastic second opportunity for a second long trade. Now with those looks at the edges of fibs, again, we're using our multiple time frame fibs and we're using our patterns on our other charts, and all we want is a reversal bar on the 5 range chart. So if we're at a very, very edge, we can either use a stop order or turn on the strategy at the area. You'll notice on the second retest of that 5-1 chart, we also have a market flow long signal. So either of these two places is going to be perfectly acceptable as an entry area, number one, at multiple time frame fibs, and then using the market flow reversal bar patterns as an entry signal. To use yet again a very recurring theme that you've already learned on your trend trades. Remember when we have a very strong trend to the upside and our background color is green? If our small triggers get on the wrong side of our synthetic triggers, but we reach Fibonacci areas and mid bands, we're going to get one more trend trade to close the big gap back to the synthetic triggers. We're going to be able to use this exact same look on our 14-2 chart to generate counter trend trades on our smaller time frame chart. So let's take a look at our two charts together. On the left, you see our 14-2 chart, very strong small synthetic triggers going up with a big gap. And we've hit Fibonacci support and a mid band, and really all of our trend trade long rules are true on the 14-2 chart. As we take this area of the yellow box and we start to look at our 5-1 chart, again, the first thing that you'll notice is that our small triggers are coming down really, really strong, and we reach multiple time frame Fibonacci support. Now again, this one's not quite as easy for a new user because of the strength of the market coming to the downside. Again, you have to really practice and become very comfortable with this look on your large chart, providing a high probability that this fib support will hold due to the trigger line configuration. When you do that, you really start to fine tune and start to say, okay, where will I actually take a trade setup if I get a reversal? Now, let me show you one more quick pattern. And you remember our last pattern that we had? So hypothetically, you didn't take the trade. You recognized the trade, but you didn't take the trade. Do you remember the same pattern that we looked at just a minute ago where the market goes up and then the market pulls back with divergence potential, and at the same time the market has a pullback in the fib to fib oscillator to the 25 buy line? At the same time, our small triggers did not cross to the downside. So again, this is a little bit different because we don't have the big gap of these triggers. But again, this is a very, very, very familiar bottom pattern that you'll see in the market. Again, we're not going short after multiple time frame fibs are hit. What we'd like to do is go long from the edges if possible. If for some reason the overwhelming momentum to the downside, makes you miss the trade, as the market comes up and bounces down off of the mid band, and you recognize the pattern that really it happens a lot. 2 or 3 bars down, small triggers do not cross to the downside. And you can see we bounce right off of our 165 EMA, this white dotted moving average. At the same time, our fib to fib oscillator is at the 25 buy line. as a second chance opportunity to get in on this trade down here. Optimally, we'd like to be in at 1650 or thereabouts. If you get in closer to the 17 area with this pattern, this is still a really good opportunity for you to take advantage of closing the market. And again, I want you to really keep in mind, perspective-wise, where the big gap is. The big gap is up here. So the potential of this trade from 1650 is almost $400. And you can see it actually goes a little bit further, and we make a pivot stop out up here at the top, which would end any of our trend trade long thoughts. So again, just to kind of bring back a recurring theme, once you get a divergence pivot stop out, remember, with your trend trades, they become much lower probability. Now that we've got our trade set up from the edge of multiple time frame fibs, we need a reversal bar. So as we're trading down into the very obvious edge of multiple time frame fibs, we'll turn on the automated strategy. Just turn the longs on and buy next reversal bar. And when this reversal bar happens to the upside, the automated strategy is going to get you into your position to go long. And again, just it's worth noting, if for some reason you were not or did not take the initial long trade, as the market went up and pulled back with that pattern that we looked at on the 5-1 chart, you'll recognize that the market flow strategy also gave you another long signal. So if for some reason you missed the edge with the pattern that was on our 5-1 chart, this market flow long signal with the arrow to the upside would have been a fantastic second chance opportunity for you to take advantage of the edge of multiple time frame fibs and a high probability long trade from the 14-2 chart. The last pattern that we'll use for trading from the edges is when you reach a multiple time frame Fibonacci resistance, but the market is a little too strong when we reach that area initially. One of the things that we've talked about is if those triggers are very strong going into a multiple time frame resistance, make sure that your small trigger lines roll over first and are headed to the downside, and then the edge of multiple time frame resistance will have a higher probability of holding. So let's take a look at both of the charts together. So what you'll see again on the left, edge of multiple time frame fib resistance with very strong triggers going up, and then the small triggers roll to the downside. And when we look at our smaller chart, again, this theme, again, one more time for trend trade should resonate with you. You've seen this many times before. We have a trend change on our smaller chart, so the background color goes to red. We have no divergence on the pivot on the low, which means we're going to be looking for a trend trade to the short side. And again, you remember the theme of if the trend is really strong going up first, and there's a larger gap back to the synthetic triggers on the smaller chart, let me just write big gap on there for you, that will have a tendency to close that gap before we'll actually head to the downside. Now this one went just a little bit further and actually made it back to the edge of multiple time frame fibs, which is what we want. Again, this is the spot where it starts to become tempting to do a trend trade. And if you do a trend trade here, and again, we'll have to take a look at what the market flow said, but again, this is not a bad spot necessarily. Obviously, once we close the gap on the triggers and then we reach the edge of multiple time frame fibs, again, this kind of becomes a trend trade from the wrong side of our synthetic triggers. Which also is the edge of multiple time frame fib trade for us. So again, it's the process of recognizing the edge of fibs at 42.30, allowing the market to weaken and the triggers to roll over so we don't try to get short too early and get run over. Recognizing no divergence on the small chart first, recognizing the larger gap after a strong run up prior, and then reaching the edge of Fibonacci resistance. And again, this is the spot where we're looking for our trade setup on the edge of resistance. So when we go and we bring in the market flow chart at the same spot, again, this is the trend change to the downside. And again, if you ignore the big gap rule and needing to close the big gap back to the synthetic triggers after a strong trend up, you may end up tricking yourself into a short trade here a little too early. And again, our trend trade rules did not become true even on the 5-1 chart until we got to here. Actually, let me make a green box for you here so we can look at these two areas together, because it's very important. Again, the trend trade rules did not become true until we were inside of this green box. So again, fib to fib oscillator must be at 75. And you can see that, as we started to reach resistance and our gap was a little above, obviously we went a little further. So again, talking about entries. Here's the rules being met at this yellow line right here. So this is the point on your chart or your market flow chart where you're turning on the strategy for maybe a trend trade short, give or take, somewhere right in here. And again, this is the very first bar to the downside that generates a sell signal. And again, this is one that you're probably going to take because it's only one tick from the resistance. So this is a good trade from the edge of Fibonacci resistance based on our other charts. Now again, I know we haven't quite gotten into the management rules yet, but the management rules for stops are pretty simple. We're trying to get in as close to the edge of Fibonacci resistance as possible. And we're looking for, usually on any counter trend trade, we're looking to at least make it back to the mid band on the larger chart before we start looking for bounces. So the target objective is from 42.30 down to about 38.60. And you can see that, if we get short somewhere around the 42 area, if we was, obviously being very patient, this pivot right here at the top, once this bar gets put into the downside, that's when we actually will trail our stop behind that pivot, and then the market will obviously make its down move. And we haven't gotten a lot into trade management yet, but once the market makes this little retracement and then another new bar down, we'll actually pull our stop down here. So we'll be able to bring our stop down behind each of the pivots, and then obviously if we were to hold longer, this would be the next pivot where we trail stops. So again, the process of reading multiple time frame fibs. We reached them initially on the 14.2 chart. Triggers are way too strong for us to use that area. As the small triggers roll down on the 14.2 chart, which are the synthetic triggers on the 5-1 chart, we reach the edge of Fibonacci resistance again. However, we have a much different trigger line configuration the second time. So this is where it becomes very high probability that this resistance will hold and start to take us down to the downside. And again, trading from the edges of Fibonacci resistance is one thing, and usually, almost always, when you have the edge of Fibonacci resistance hold and the market makes a strong down move, the next trend trade after that is almost always a winner as well. So it creates, a high probability edge at the Fibonacci resistance for us that subsequently turns into a high probability trend trade after that. So as you go back and study your charts, you'll see, go back and look at the edges of Fibonacci support or resistance. Anytime you get one that holds, usually is followed by a second trend trade after that. And again, for us, entry criteria wise, really the most important thing for us is to be at the right spot. Once we're actually at the right spot, then turning on the strategy and then turning on the buttons so we can take advantage of the market movement. So again, we don't really look at the market flow strategy or entry criteria until we reach the spot that we want to trade. Then, either this one, which would be, probably your entry, or if you really waited to the edge, it's only a one tick difference, then this one would be your entry as well. So it'd probably happen on the yellow one. And again, a 10 tick stop, you have to really think about your stop placement. Your stop's going to end up being up here. So you're going to avoid getting stopped out, and then after you get your pivot, you'll move your stop down, and then after you get new pivots, you'll move your stop down, and then after you get new signals to the downside, you'll move your stops down or take new trades, obviously, as the market progresses. So again, just to review, if you reach the edge of Fibonacci resistance and the triggers are very strong, you have to wait for the triggers to roll over, wait for the area to be retested, and then you can take advantage of the edge of Fibonacci resistance in this case, or support if it's coming from the bottom. In this final section, we're going to look at the management of a trade, when to move a stop, when to get yourself to break even, and when to take a profit. In looking at your 14-2 chart, when you're going to place a trade, you should think about a few things. What are my synthetic triggers width and location on my 14-2 chart? Where did we come from before I'm going to do the trade? What are my trigger lines look on the 14-2 chart? And then what could be the possible first trouble spot that I would hit on my 14-2 chart? And you're going to have to repeat this process, whether it's a long trade or if the market reverses and you start doing short trades, you have to, again, think, what did I have prior divergence up at the top? What are the strength of my trigger lines? And most importantly, where are we going? What's going to be the first trouble spot or support area that I'm going to hit with my short trade? And it's not just what's in your way, it's what happened prior. Did we break multiple time frame resistance? Where are the small trigger lines prior to my entry? Was there divergence prior to the entry? Which side of the synthetic triggers are my small triggers on? And then ultimately, what's in the way between my entry area and my Fibonacci target area? In this following picture, you'll see very, very simple, very easy looks for a trend trade long. Small triggers above our synthetic triggers, but no divergence. The market pulls back to Fibonacci support, and absolutely nothing in the way until we reach our Fibonacci target up at 64.72. Now, once we reach 64.72, you'll see we put in the potential for divergence, and the market trades back down to the downside. And again, if you were to go short at the edge of resistance, usually the mid band is your first target. So as we reach the mid band the first time with our synthetic trigger still up, if you were short, then that would be a really, really good spot to start watching for a profit target. And You can see we went a little bit lower and we made a little pivot stop out. Again, anytime you reach a prior pivot, high or low, especially when there's a divergence at that pivot, it's very, very significant. If you cannot continue down and the market starts to get back above that divergence line, you want to get out of any type of short trade. Many traders who are trading long trades will use that look as a long look to get back up to Fibonacci resistance. Usually the market will make one more push back up to retest a Fibonacci resistance if we're in a strong trend to the upside. This pivot stop out is usually where that spot happens. Now, as we trade back up into Fibonacci resistance, this is where our counter trend traders start looking for the opportunity for a really high probability short trade. Prior Fibonacci resistance with divergence, with a divergence line at our Fibonacci resistance area, a second divergence at the high, and this is the type of trade where, again, because we've already had the first move off of resistance, typically the second move will not only reach the mid-band, but continue a little bit lower. So the expectation the first time from resistance is that the mid-band area will hold and make the market go back up. The second time from resistance, typically the mid-band will break, and even after a little retracement, the market will continue down a little bit lower. So again, you have to go into each of your trade setups with an expectation of the target areas, should they hold? How exactly am I going to manage my stops? What should happen next based on the read of my fibs, trigger lines, and divergence areas? So I want to go back to our 14-2 chart. Again, one spot where we're looking for a long trade, one spot we're looking for a short trade. Now we're going to start with the trend trade on the left side of the chart first. You'll notice first we have a trend change to the upside. We have no divergence on the pivot above the trend change. Because it's a larger gap back to the synthetic triggers, we're looking at the blue Fibonacci support line and the synthetic triggers for the area in which we're going to actually place the trade. Now, once we reach the area and once the trade is actually placed, so again, obviously the closer you can get into the area, the better. What I've done is I've put a 10-tick risk box, if you will, for that's in red. And again, with this 10-tick risk box, I've also drawn a corresponding 20-tick profit target window. So again, anytime you're about to take a trade, I want you to be able to visualize, and if you want to, you can even put boxes on your charts. Put the 10-tick stop in so you can see where your stop would go, where a max risk would go. Put in a 20-tick profit target box so you can see how much room you've got to your trouble spots. And then you can see in this first scenario, if you got in pretty close to the right spots, you very easily made 20 ticks before you got to the prior divergence highs. Made more than that by the time you got to the next Fibonacci resistance. So again, very easily able to pull 20 ticks out of that first long trade. Now, stop placement's going to be the same for every single trend trade. You're going to initially get into your position, and initially you're going to have 10 ticks risk. What's going to happen after you get into the trade and after this bar closes to the upside, you're going to put your stop literally 1 or 2 ticks below that pivot. So you may start out with a 10-tick risk. But after the pivot, depending on your entry area, you may end up only having 3, 4, 5, or 6 ticks worth of risk. So it really starts to add to the risk reward ratio when your average risk will end up being 6 or 7 ticks and your average profit target will be 20 ticks. It's a really, really nice win to loss ratio. Now, if you remember from our trend trade section, if all three of your charts have negative divergence numbers on it, like we had up here, obviously you can just see the 5-1 here, but we also had it on both of our 14-2 and 5 range charts. So that's the type of look where we won't do any more trend trade longs after that, and we'll wait for a trend change and we'll start doing trend trades to the downside. So you can see as we work our way down and we actually change the trend to the downside, you'll see a repeat of what we had on the way up. We have a trend change, no divergence on the lows, and you can see this is one of the situations where we have a perfect look for a trend trade short. Obviously, the closer we can get into the perfect spot, the better. And again, one of the things that we're looking for is where is the target? So the entry area is as close to 67.73 as possible. Our target area is 63.49 to 63.43. So again, you can see with our 10 tick risk box and our 20 tick profit target box, this trade has a high expectation of making at least 20 ticks profit for us. And again, our stops are going to remain at 10 ticks until after this down bar. Once we have the down bar after our entry, then we're able to reduce the risk and place the stop above the pivot. And again, only after the down bar are we able to reduce our risk behind the pivot. Only 25% or less of your trades are going to be perfect. The other 75% of your trades are going to have something in the way. So it's important that we read our indicators and have indicator-based rules on how we're going to manage our stops and targets. In this chart, you'll see gold 14.2 on the left. And this is one of our easier management techniques. When we have a very, very, very strong trigger line look on our 14.2 chart, with both our synthetic triggers and the small triggers very strong below. First and foremost, it's trend trade shorts or nothing. Anytime you get the really strong trigger line look, as you've learned in our trend trades and reading fibs and triggers, we want to continue to do trend trade shorts. Now, you're going to be faced with a situation where you have your first trend trade short. And when we start this trade out, you can see existing trend down, no divergence on the low pivot, and we pull back to Fibonacci resistance and our fib to fib oscillator for the first trend trade short. What you'll see next is that our small triggers are physically above our synthetic triggers. Now, once price reaches the prior low and there's divergence potential, we have to look at managing our position. For this, I'm going to take us down to our two smaller charts. So you'll see our first trend trade short area on the left on our 5-1 chart. You'll see the corresponding down bar on the 5 range chart, which would be your entry. And then once we reach the prior low, you'll see we have potential divergence on both of our charts. Along the way, on the way down to the divergence prior low, you'll notice we have a white paint bar on the way down. Generally, as we reach a prior low or a trouble spot, such as our synthetic triggers with potential divergence, we can move our stop down using the market flow behind the white paint bar, reducing our risk. The second part of that is, if you make an up bar on the 5-1 chart, you want to be out of your position. So again, at this spot right here, we'll have divergence becoming true with an up bar on our 5-1 chart. And when we have divergence on the low, typically we're going to stop out the last pivot high, and then we're going to get a second opportunity at the same short trade from a better spot. Now, very much in line with what we saw with our counter trend trades. The first counter trend trade stopped at the mid-band and went back up. Our first trend trade stopped at the synthetic triggers and went back up. Now, if we get that pivot stop out and we get that second trade opportunity, the anticipation with the stronger 14-2 chart is that the second time down to the lows, we're going to actually exceed and take out the lows and continue the trend to the downside. So not only is our profit target much larger on the second one, or profit potential much larger on the second one, the stop management's going to be a little different as well. Once you get a pivot stop out and a down bar, you're able to pull your stop above the high of the market flow pivot stop out bar. And using the same white paint bar logic, you're also able to reduce your risk once again once you get a white paint bar down, helping your short trade. Again, it's imperative that you recognize not only what the trade is that you're currently doing, but what happened prior. So as we go back and we take a look at our 14-2 chart, this spot up here was more than most likely where you were doing your short trades from the edge of Fibonacci resistance. And again, if your profit target was 20 ticks, you very easily achieved your 20 tick target. Then, just as we've discussed before, if you get a trade from the edge that ends up working, it's usually followed by a very good high probability trend trade. So again, you can see the trend trade materializing. Trend change to the downside because of the prior uptrend and the gap back to your synthetic triggers. It really starts to narrow in the area where you're actually going to start looking for your short trade. So as they close the gap back to your synthetic triggers, we're going to be looking for a short. Now, this short is a little bit different. Number one, it has plenty of room to get down to the next target. But what you'll see is a combination of two different things on two different charts that are happening at the same time. Number one, on your large chart, you have a prior pivot low. So anytime you reach a prior pivot low and you have divergence potential, you have to watch out for that prior pivot low to cause a reversal in the market. Now we have the added benefit of our small charts not only having a prior divergence low at that spot, but also having Fibonacci support at 1332. This would be an absolute target for us. So even though our large chart has the appearance that we're going to make it down to 3060, because of reaching the prior pivot low and the potential for divergence and the Fibonacci support on the small chart and the divergence potential on the small chart, we want to get out of this short position a couple of ticks ahead of or above the Fibonacci support to maximize the trade. Now, I'm going to go just a little bit further and remind you one more time about that pattern we talked about. Remember where we have multiple divergences on all of our charts at the exact same spot? That means we're going to quit doing trend trade shorts. So this would be the trend trade short that you would skip. And do you remember the pattern that we looked at before? Fibonacci support at the lows with divergence, the market making a strong move up, the market pulling back to retest Fibonacci support with even more divergence, and our fib to fib oscillator being at the 25 buy line. After divergence on all three charts, this is the spot where our counter trend traders will start looking for trend trades to the upside. So again, I know we're kind of handling quite a bit of information on this one chart, but it's counter trend trade on the large chart from the edge of resistance up here at 1336.40, which would have yielded at least 20 ticks profit. And then we move into our second trade, which is the trend trade short on our smaller chart from Fibonacci resistance and from the synthetic trigger lines after they get retested. Trading down to Fibonacci support, prior lows on the large chart. Anytime you reach divergence and prior lows, you want to exit your position. And then if you get an opportunity with this pattern on a retest, again, higher small triggers, divergences on all three charts, you can then use this Fibonacci edge as your first opportunity to go the other way. Now, let's take a look at our market flow chart at the same spot. And again, as we go back in time, this one's pretty easy to see up here at the top. This is the edge of our Fibonacci resistance and where we're looking for, potentially a short trade. And again, if you're not a counter trend trader, don't worry about it. As we work our way down, again, this is why we really like to superimpose circles on all of our charts. The trend changes to the downside. Let me get rid of that pointer. And again, this is where the market pulls back, and this is where we'll turn on our strategy that if we get any type of reversal bar short signal, we're going to go short. And again, keeping in mind, we're not going to move our stop until we have a paint bar down or a pivot down on our 5-1 chart. And you'll see we'll also have, again, a white paint bar on our market flow chart, which will allow us to reduce some of the risk further. And then you can see very clearly on this chart, we make it down to our target very easily. And again, it's not going long down here at this target. It's after this area holds and after the divergence is established and after the move goes up, this is the short trade that we're going to skip. And then if you have a market flow signal at the fib with the pattern on the 5-1 chart that we were talking about. Sorry about that. Let me move that over. Then you'll get the first opportunity for the market to go the other way. So again, as we work our way down, you can see on the 5-1 chart, initial stop will be, well above all of this resistance. And then after the white paint bar down, which also incorporates this tail bar, we'll be able to trail our stop behind that area to reduce our risk. And then never even really needed to move it again. We made it down to our target. So again, once we make our target, then if we were going to do this long trade, right, again, our stop would be 10 ticks. After the reversal bar to the upside, then we would be able to reduce our risk and manage our position. Again, this whole process just repeats itself. So again, if you were long from here, remember, first counter trend trade long. Once we reach our mid band and or prior divergence highs, stops are break even or better. And again, first counter trend trade, you don't necessarily want to get too greedy. You can see the market did go up a little bit further, but we did bounce down from our 165 EMA. And then we basically had the same pattern again, back to the fib to fib oscillator at the 25 buy line, Fibonacci support, and even more divergence. And again, our counter trend traders would use this look for one more long trade to the upside. And again, stops are always the same. They start below the pivot, and then they move up. And then again, if we get a white paint bar and some tails and some reasons why we can move our stops up, we can move them up. And then as we trade into our target areas, obviously we're already taking profit. And then the process just repeats itself. Again, you can see trend changes, big gap back down to our synthetic triggers where they close the gap and the market reverses trend. Anytime we talk about profits, please pause the video, take a moment to read the disclaimer. It's imperative that you keep in mind the daily objectives. We want to make $400 per contract per day. So we could do 120 tick trade on crude oil, 120 tick trade on gold, and we've achieved our $400 profit. It's through consistency and trade application, which trades are you going to take under which circumstances, consistency with your pivot, stop management, managing your stops at trouble spots, and taking profit at the correct area that's going to enable you to have an opportunity to make $400 a day or better following the correct trades. So again, a couple of key takeaways that we want to talk about. Don't move your stop until you get a reversal bar on the 5-1 chart. Move your stop when you reach a trouble spot on your chart. When you're doing the first trade against the trend, always watch out for your mid-band and smaller profit targets first. If the market retests the area where you do a counter trend trade or a trend trade from, you'll have the opportunity to make more money on the second trade. Also, anytime you reach a prior major pivot in the market, watch for exits. The market has a tendency to stop out those pivots and then reverse and go the other way. Again, we thank you for your time. We look forward to seeing everybody in our live class and look forward to teaching you how to make all of your goals and objectives day trading Fibonacci. Now that you've completed each of the tutorials, you're going to have to actually practice trading in order to become a better trader. Tutorials are great. Watching the live educational room is great, but absolutely nothing will help you prepare for trading live money in the real market than practicing trading on the live market. Now, we have an added benefit with NinjaTrader. You're able to download and replay every day in the market. So you can actually go back and day trade last week and you can day trade yesterday. And one of the recipes that we've found that's been very successful is to simulate during the day and then at the end of the day go back and run market replay and retrade the day and correct any mistakes that you might have made. So let me show you how to download and get started on market replay. I'll give you one more quick visual on what you'll see on your charts when you do market replay. This is an example of one of our clients who's been practicing during the day and doing market replay after the day. You can see he's writing his rules on the chart. So regular trend trades or trades from the edges. And what he'll do then is he'll actually go in during market replay and he'll turn on the automated strategy at the spot where his rules are met. So he'll go in and not only take the trades with the reversal bars from the right spots, but he'll practice his trade management as well. So again, this will give you the ability, and I just kind of wanted you to see the visual. Take a look at your large chart, write the rules on your 5-1 chart, and then practice the entries from your market flow chart. And what you'll end up with is really a very, very good practice, number one. And then number two, you'll start to see how much financial potential there is. Let's say in this case, he's trading 2 contracts. So for this particular morning, had he have taken all of the signals and done it properly, there was $2,500 in potential with the trade setups. So what you're working towards is closing the gap between theory, practice, and then real-world application on your charts. And again, keep in mind, our objectives are to make $400 a day per contract. In this case, he made $1,200 plus for the day, so obviously 3 times the objectives. So let's get it into how to download data and how to set up your charts to do market replay. So there's a process to it. Number one, if you just have standard NinjaTrader, you're going to go into File and Utilities, and you're going to download replay data. And essentially, let's just say yesterday's, right? So we can go to crude oil or gold if you wish, and we can say, okay, today's the 29th, let's download the 28th, and then we'll say okay to that, and you'll see it'll actually download that data. And if you want to do more than one day, you just go back in and you just go download replay data, make sure you select gold again, and then do the 27th. And you can literally in just a minute or two download a week's worth of data. If you've got software and you've had software for a while and you want to be a little more fancy, you can go in. There's a little service called marketreplay.net. You can visit their website. And what it does is it allows you to download multiple contracts at the same time, multiple days at the same time. And it also allows you to download a continuous contract. And the reason that this is important is because, crude oil every month has a new contract. So if you go back, let's just say to February, instead of having to say, okay, what month was February's or what month was November's, and making sure you download the right month and you're practicing on the right month, you have this little continuous contract data. And, if you buy that service, $150 for the year, I really think it's worth it, especially when you're learning. It will add in this little batch download replay data feature, which is really neat. And I use it all the time. And what it will do is it will allow you to add symbols like, let's just say the euro US dollar. And you see the little 2 hashtags. That means that it's continuous contract data. Crude oil data. S&P data if I wanted to, gold data if I want. And I can actually go in and I can say, give me from Sunday all the way to right now, and download the continuous contracts. And I can go in and download this, and it's going to, again, there's no data on Christmas, but it's going to go in and download all of those days and all of those contracts very, very easily for me without me having to go in and do one market and one day at a time. Again, this is something that's optional for you. It's not necessary. You can just download 2, 3, 4, 5 days worth of data without any trouble and go do market replay practice without any trouble. So again, it's not necessary. However, very, very beneficial. Let's just put it that way. So again, I've probably got months worth of data downloaded myself. So once you actually are connected to your live data and you download your historical data, to actually do market replay, you're going to go into disconnect from your live account, and you're going to go in and connect to the market replay connection. And essentially, it's going to bring up this little controller, and it's going to tell you that you've got, these days worth. And, essentially, I think it's best, just to stay in the week that you're in and just practice that week. But if you want to really go far back, one of the better things to do is to make sure that you've built that chart and you've downloaded, 30 or 60 days worth of data. So, and I've done that for historical data purposes. So let's just say I want to go back to November 6th. Today's December 29th. Now I have to go in and, again, this is a little bit of a tedious process, and you have to do it every time, but you just go into File, New Chart, and, again, let's do gold here. Oops, excuse me. I'll do the continuous contract data. So you have to build your 3 charts that you're going to do your trading on. So again, we have a 5-1 chart. Make sure you've got 30 days back of data. If you just hit DD, it'll take you to the 24/7 default template, or you can use the drop down and select it. You want to make sure you've got that because we want all the data from overnight. And if you want, you can plot your text and markers so you can see where your trades were. And you're going to want to put on your fibs 5-1 red and blue. So you have to go in and, again, you have to build the chart. Hang on, it went to my other monitor. I'll pull it over real quick. All right, so once you have your 5-1 chart, now we've got to build our 14-2 chart. And again, same process, file, new chart, going down to the gold continuous contract because I've got that service. If not, you just go to the month that you're going to trade. I'm going to build a 14-2 chart, make sure you've got 30 days back. You can always right click and set default for that time period. Go into the session template, just hit DD on your chart. It's a little shortcut that'll get you there. And I'm not going to plot the executions on the 14-2, so I'll do 14-2 fibs, red and blue. And then I will say OK. And now I have my 14-2 chart. And again, you can kind of set these up however you see fit or whatever is best for you personally, you know, your personal preference on the look. Oops, I went to my other monitor up above. Bear with me a second. And then, last but not least, you have to go in and you have to build your gold range bar chart, 5 range. Hit DD, makes it default 24/7. And we definitely want to see our executions on the range bar chart. And then, you know, there's a template that's in here that's 5-1 range market flow. And you're going to have 5 range market flow strategy. The only difference is the strategy template doesn't actually plot the market flow indicator because the market flow strategy itself will plot the indicator. So I'll show you how you're going to get that set up. So take your 5 range chart. I'll just blow it up for you here real quick. And you're going to right click on your chart, and then you're going to left click on strategies. And then once you're in your strategies, you're going to double click on the market flow strategy. And then you're going to set it up. Again, the last page of the user of the trading plan has all of this information, but basically this is my default setup. I don't have the high volume limit entries, but I have reversals, white paint bars, yellow paint bars done. Number of dots, 2 and 1. Basically, these are all your default settings that are already in your software. Not doing reversals because basically it's one trade, one direction. And then you'll see you're on your replay account, and then you just turn the system on to true, and then you just say OK. And again, directions for applying templates and running systems are all going to be on your trading plan. So once this comes up, now we're ready to trade, right? We've got 3 charts. And again, I know it's a little bit tedious, but rebuilding the chart each time makes things really much easier. So you've got your 3 charts. You can kind of minimize your control screen. And then to get started trading, you know, you're just going to start by, again, you got to follow the rules. So, you know, anytime we've had, let me just speed this up just a little bit so it goes a little faster. Again, anytime we've had, you know, a strong move on our big chart, so you can blow this up, you know, and play it as slow or as fast as you need to. Sometimes early in the morning it's real slow. So you want to define, you know, areas on your chart where we'll have, you know, not only trend trades, but stab backs on your big chart. And again, because we've had a pivot stop out up at the top, as you'll see in the management side of it, we will traditionally come down here and make some new lows. So again, as we start to push down into that area, you know, one of the things that you'll see, you know, or one of the things that we'll do with the software is, again, the execution. And you want to make sure you turn your strategy on. And essentially what we're trying to do is we're trying to say, okay, pivot stop out at the top. We know we want to get down to some lower levels down here, right? So as we start to, and you can fast forward your market replay, and to slow it down to 1x speed, you just click play again. So again, I'm just showing you increasing the speed a little bit, just so we can kind of get to a trade set up here real quick. And again, as you start to trade down into the area that you want to trade. And again, that's why I think it's important that we use these circles and you use the historical studies so you know where and when you're supposed to be putting these trades on. Let me speed it up for you here real quick. All right, once you start moving down into the spot where you want to trade, it's very simple. When you get to the spot, you just want to turn the longs on and you want to put buy next reversal bar on. Very simple. So if you're doing a long trade, that's it. If you're doing a short trade, just turn the shorts on. And essentially what's going to happen is as this market replay progresses, if you get to a spot where the trade's going to happen and you get an up bar, it's going to automatically get you into your trade. So it's going to make the process, again, defining your areas where you'll do your trade with the rules. And again, you can write the rules on your chart. You can just copy paste the rules on your chart. So again, if we get to, we'll just take a look at it. Again, we had a trend trade here. So because we had a pivot stop out, we're looking for another pivot stop out. So again, F12, and you can, again, we're looking for either a trend trade or, the best of all worlds is get to the edge of multiple time frame support. So structurally on your 5-1 chart, that's where you want the rules to be met. Once the rules are met, minimum rules for a trade, then you go to your market flow chart and you turn on the strategy. Right? Now, if we break through the low down here and then we don't want the trade anymore, obviously you should turn the strategy off. As long as we, don't really violate the area where we want the trade from, you really just let the strategy get you in. So I'll kind of speed it up.
Order pending.
So you'll see. We had the strategy on, buy next reversal bar, so you can see that the system puts you in, and essentially once you start trading, you're able to go in and actually, move your stops, you can move your targets based on the rules, and you just want to practice. Again, I thought I'd turn this on, but maybe I didn't. And you just, again, you want to go through the day and you want to place the trades and you want to practice. And, I have found it best if you take pictures, because after you get done doing market replay for a day, number one, you want to see how much money you made. Number two, you want to double check yourself and make sure that you were doing the right trades with the right rules met. And these are also things that, if you wish, we can review in class. So you can save your pictures with your screencast. You can go into your screencast history and you can save, this is one that we did today. You can save your pictures and you can save your trades and what you were doing and why you were doing it and share them in class and really get feedback from the educator. And then as you go forward, and again, you work your way through trend trade, multiple fib trades, trend trade shorts, and again, it's just get to the spot where the rules are met and turn on the system and let it go. And again, once you've done that, then, you've basically allowed the system to do the entries for you. And again, I just turned it off, so.
Order pending.
Again, and you can always do manual trades. Just hit the button if, you're not in.
Order filled.
And very, very simple. Again, you want to manage your trades and you want to do it properly. So again, if you're, coming back into an area and you want to buy it, just turn on the automation, right? So we're back to the spot where we want to buy.
Order pending.
For a reversal bar. The system automatically gets you in without you having to do any thinking. And the system's going to read the market flow. It's going to read how many buyers or sellers were in there. And it's going to dynamically put you into the trade based on all of the criteria that you set up in the inputs. Very, very simple. And then, as the day progresses, you're able to go in and just kind of evaluate, where did you get
Order
in, where
filled.
did you get out, what was the results of the trades, and, in the end of the day, and again, because you can speed it up through the slow parts, most of the time you're going to be able to do market replay with the strategy and the rules on your chart, and you're going to be able to look at it, after you're done and say, okay, that was a trend trade, and that was the edge of fibs, and this was a trouble spot where we got out, and little pivot stop out got us back in. Again, I'm kind of going fast with that, and you can evaluate where'd you get in, how much did you buy, where did you get out, did you do it right, did you do it wrong? And then again, one of the more important things is labeling your charts with the rules, right? Allowing the strategy to get you into a trade and just becoming comfortable with it. And by the time you get done doing a week, this is, this last week's worth, so $1,500 on the 27th, trading 2 contracts. $1,700 trading 2 contracts on the 26th. On the 25th, $1,300 trading 2 contracts with the rules and the market flow. When you go back to the 25th, and you can say, here was the rules on the 5-1 chart, here was the market flow, $1,300 on a 2-lot. And essentially, on a 2-lot, anything in the morning by lunch that's above $800 is going to meet the minimum, kind of goal on what we're looking for you. So you can see this person far exceeded the goal. And I always like to use, clients' pictures too, because it just makes it easy. Again, think about the goals, right? Our goal for you guys is to teach you how to make $400 per day on one contract. Whether it's a couple trades on gold, couple trades on crude, just net at the end of the day, averaging $400. Even in a slow market environment, you can see, $1,000 on the 23rd, $1,300 25th, or 26th probably is the trading date. Replay that was done on the 26th, you can see over $800. And, again, building confidence, most important thing, right? So we want you to practice. We want you to read through the plan. We want you to watch the videos. We want you to do market replay. And again, this is kind of the goal for you. You've proven that the trades win, that you've become 100% comfortable with the trades and you follow the rules on the trades. You understand the differences in the different types of trades and managements that you're going to do. Annotate and post your pictures of your trades in class when you're doing them live so we can talk about them live. And again, once you work through these 3 skills, and it takes a while to kind of work through the process, your trade recognition will be right on, your entry execution will be handled by the automated system, and then the management of your trade will become very easy once you follow the rules. So again, if you have questions, let us know. Really, really important that you not only, go in and watch the videos and study history, right? Like this video talking about how to study trend trades in history. But more importantly, right, you want to be a trader and you want to make money trading, so you have to practice trading and pushing the button. No easier way than market replay. If you do it wrong, look, just back the day back up.
Order canceled.
Right? Go back and, some of the people who've used our software, they'll trade the day, and then, once the day's over, they'll actually just go back to the beginning and do it again. And they'll do it again and again and again until they get it right. And those are the people who end up being the most consistent with our software. So again, you can see, I just put it back on the 6th. It started over. We already know what's going to happen, but we want to make sure that we follow the rules. And that's really the most important thing. And then once you're done with a day and you've got it right and you've followed the rules and you've practice the execution, go to the next day. So if you've downloaded a whole week's worth of data, just, when you're done with the day, just click on the next day. It'll roll forward, and realistically, over the course of several hours, you should be able to almost day trade a whole week's worth of data. Definitely a much more efficient and, much more repetition for somebody who's new. And, again, you can take it slow if you wish. Most of you guys are very, very motivated to start making real money as quickly as possible, which is great. So the more you practice, the better you're going to be. And market replay and really just rebuilding your charts and doing a whole week's worth of trading every day, absolute best way to start making some money quick. So I appreciate your time, and I look forward to seeing everybody in the class. If you have questions, let us know. Otherwise, this is the last day of 2017. You guys have a safe and happy New Year's, and we'll look forward to everybody having an absolutely fantastic 2018.